Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
Jay Powell has made it really clear that right now the priority is inflation.
This is about really pushing back hard against the recession consensus.
They succeeded in what we expected, namely delivering a hawkish skip.
We expect them to raise rates both in July and in September and to get to that 0.5%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. After the Fed decides, we decide to continue forward here. John Ferro on assignment, 3 islands in Italy. Tough detail for Mr. Ferro. Lisa here with me as we plow through a Thursday. Claims here at 8:30, but we're going to claim that yesterday was almost on the edge of history-making for the central bank. I got it wrong. I was surprised.
Perhaps this will mark the end of the rate hiking cycle, and that is really one of the themes that I keep hearing about in analyst notes, despite the hawkish rhetoric. Why, if they had such hawkish rhetoric and such hawkish projections, didn't they go that particular meeting? The polarity here, Morgan Stanley, Ellen Zentner just flat out comes out and says, and we heard soft landing yesterday from Seth Carpenter, Zentner says the Fed is done. Madison, MetLife, and over at Citigroup, they just simply say they just should have raised rates and forgot about the hawkish, the McKee mumbo jumbo we heard at 2 p.m. Well, at a certain point, if their actual projections, yes, they change, they become more hawkish, they increase their economic projection. We heard there from Jeff Rosenberg that basically they're gaming out just the scope of a potential recession or not, the sort of soft landing kind of scenario. But they didn't want to move, and they didn't want to commit to a July move. That, to me, was indicative of something. What matters right now, Lisa will brief you here in the coming 48 hours. Tomorrow, Bullard, Waller, and others as well. They start barking, I think, start speaking. Bullard, it starts tomorrow. Are you prepared for this? It's your job, Lisa, to brief us on this madness. Well, I will definitely have fun with all of that, as I'm sure you will as well. And actually, Jay Powell talked about yesterday, listen to the Fed speak. They're all going to speak for themselves. I can't represent them. It was herding cats, and you could kind of feel that under the hood, how to get to a consensus in a way without necessarily creating the appearance of some sort of dissonance inside the members. To the ECB today, and of course, Maria Tadeo in Frankfurt will have full coverage of that different ballet in Frankfurt. But what is fascinating to me is how yesterday had the spirit of sort of, we have our own Bundesbank out there being hawkish, even though maybe the chairman wanted to be more like, say, Finland or, pick another nation. But all of a sudden, we were sort of Bundesbanky yesterday. Yeah, I'm curious how much we end up with a euro breakout as we do get some move today by the ECB and what the projections are. Yeah, we're definitely moving up. The other thing I want to note from yesterday, the fact that the NASDAQ rallied, even in the face of the potential for higher rates, to me, was a sea change. We have officially moved past big tech being interest rate sensitive. Perhaps it's AI, perhaps this is the new haven, but this shows the nature of how this is the defensive trade in a new way. We're going to dive into that with Amy Wu Silverman here to start strong in the equity markets here in a bit. I'm going to look at the data and suggest a little bit of a tempered red on the screen here in the markets. Futures, SPX still above 4,400. That's all you need to know about Chairman Powell getting out of the press conference relatively equity unscathed. The VIX 14.06. We've been looking at oil 68.93. Thanks to Will Kennedy and our team for reporting on that. And in the yield space, really don't know what else to say. We've got significant curve inversion out to 92 basis points. The vanilla 210 spread, 10-year yield 3.81%. We're really not looking at a 4% level yet. But the gyrations still continue in bonds. Yeah, well, and the score, just to give you a sense of Fed fund projections, there now is almost a 70% chance of a rate hike being baked into Fed funds futures in the July meeting following and ending the end of January with 5.1%. All right, as far as today. Save us with a brief. John Lawler. John Lawler doesn't believe in the parlay game. CFO of Ford at 7:30 a.m. Eastern. Very curious to hear what he has to say about Tesla and their charging stations, how much he's buying into that and what that means. Megan Green also joining us. I'm really thrilled to have her come on. She's joining next month as an external member of the Monetary Policy Committee over at the Bank of England. She is senior economist at the Kroll Institute, and she teaches at Brown. And at 8:15 a.m., ECB rate decision, followed by 8:45 a.m. press conference with Christine Lagarde. Watch the euro. How much does that break out? And at 8:30 a.m., this data dump is important. You picked up an initial jobless claims. Yes, we get Empire Manufacturing, the first read on the month of June. But to me, retail sales, incredibly important. How much is the momentum behind consumer spending continuing versus diminishing?
70% of the American economy, and of course we go to the control group on that. But the answer is that's a nominal statistic. So even if you say, a la Zentner, the Fed is done, if you get some form of sticky inflation, 3%, 4%, dare I say more, I'm talking about top-line inflation, then you get a top-line retail number, which is spirited and adds into nominal GDP and the rest. That's sort of the cycle on it. So we'll look at retail here carefully today. In the currency market, I do want to note renminbi, lots going on in China. We'll get to that through the show today. I rounded up. I got a 7.16 on Chinese yuan. Amy Wu Silverman joins us now, head of derivative strategy at RBC Capital Markets. Amy, it's real simple. You say we've got upside here, and we may not get the traditional equity market rotation. This is important to global Wall Street. Why will we not rotate?
Yeah, this is the question, we've been asking the last few weeks, and I thought yesterday's knee-jerk reactions, Tom, were just really telling. So, look, for the last few weeks, the options market's been chasing upside in IWM, and then you get a little bit of a hawkish tone from the Fed and from Powell. And what happens? You have IWM sell-off yesterday, you have Q's rally, you have NVIDIA rally. And I think that just tells you, how the market is thinking about these different sectors. The one question we've been asking ourselves is, if the data continues to come in more economically strong, is it possible essentially to have a narrative where it's not really about value versus growth or small versus large cap? It's simply tech becomes your rallying point because of a secular story, perhaps, and then IWM becomes more of an IWM story on the more defensive and, that side, but both can rally at the same time.
Just let's really develop some of what you were talking about, this idea that big tech has become defensive, has become the secular growth story, and really perhaps the fear of recession is playing out in the small caps in a new way, and even in some of the non-tech names, which really highlights a diversification that is very different than it was 6 months ago.
Yeah, exactly. And one thing I'll say is, what has been interesting, especially given yesterday, is we saw IWM sell off sort of in that reaction to the hawkish tone from Powell, but we didn't see any change in the option sentiment. So going into yesterday, Lisa, the option sentiment in IWM was quite bullish. You saw almost a skew inversion where that call demand is outweighing the put demand. And that's been true for the last few weeks when people think, that small cap is going to kind of burst out. But that didn't change yesterday, even though we did see continued optimism in the large caps as well. So that's why I've been saying, is it possible the narrative no longer becomes this rotation from small to large or from growth to value, et cetera? It's just simply they can go along two different tracks and two different narratives.
So basically, are you saying that people who are talking about bad breath getting into some sort of broadening out, not happening, and it's not going to happen, even if you continue to get a rally in the equity indexes?
Yeah, you said bad breath, not me this time. I think that is possible. And the one major implication that has for volatility is one reason we've been counting on that breadth to widen is because it's going to change our correlation function, which obviously feeds into your index volatility. But if we don't get that happening, if you continue to have people who've missed out on mega cap tech having to reallocate into it, even as that small cap story is playing out, I don't think you get much of a change in correlation, which ultimately, dampens volatility on an index level. So it's possible that, you have all these events ahead, but there's that suppression of volatility because that correlation component of volatility continues to not move because of the breadth.
Amy, if we believe in a bull market, and we've had a first leg from October, I've been calling it the Ankampur-Yardeni bull market after two people that were way out front on identifying it. If that's the first leg, how do you use the cross moments? How do you use derivative mathematics to assist in identifying the second leg of a bull market?
Yeah, so I'll give you one Bloomberg function that I like to look at a lot, which is VCA, which gives you the volatility landscape across, any constituents like the S&P 500. And when you organize that, Tom, by skew levels, so again, that component of call demand versus put demand, you start to see where the really, really bullish parts of the market are. So if you looked at that right now, among your top 10 names, probably not shocking to you, is going to be AMD, it's going to be NVIDIA, it's going to be Tesla. And it really tells you not only where the market is out front the most on, but where it's beginning to start to see changes in sentiment. And you are starting to see some of the more, IWM type names go in there into those sectors rather than it just being mega cap tech.
The big names out there, whether it's a big name Procter & Gamble, the big name Walmart, Intel is a dog of the moment, or as you mentioned, AMD, are they under-owned by institutions in the traditional sense, not hedge funds, but long-only buy-side? Are they under-owned in what's worked?
They are, and that's part of the problem. There's sort of two interesting things. The first is that portion of the asset management community you've been talking about has been underallocated. And the issue is that begets this positive momentum situation where we've talked about in options where you get that exacerbation of gamma. So essentially buying of calls can lead to more buying of stock, which can lead to more buying of calls. This is what you saw during the meme craze. And the other thing is, historically, that segment of the market has that problem with owning things in such a narrow concentration. So if the breadth of the market starts to expand, that ultimately helps them in participating in the rally.
Yeah, the headline there, folks, if you're keeping score at home, is Amy Wu Silverman says Apple is a meme stock. That's what we're gonna go with there. If I get gamma as an acceleration, within the derivative jargon, are we gamma-ing our way to a melt up?
So, we already have. That's already been happening, and I think that can continue. So when you look kind of to the week right post NVIDIA's earnings, that's what you saw. You saw those skew inversions, on that VCA function, and then you continue to see that now. That actually hasn't changed all that much, even though, some people are asking if that AI rally is tired. You don't yet see that in the options. You continue to see that call imbalance pretty heavily. And then each day that goes by, we actually start to see it in different parts of the market, not just mega cap tech. And that's why I think it's very telling in terms of the sentiment and options. Those winds have really changed over the last month.
Amy Wu Silverman, terrific opening brief for us today with RBC Capital Markets. Surveillance correction, we want to be clear on this. Apple is not a meme stock. I don't want anybody casting aspersions.
News you need to know.
News you need to know right now. What's so important in there, and this goes back to my conversation with Nicholas Nassim Taleb here 10 days ago or so, is so much can be learned by studying the dynamics and the oscillations, if you will, of the consensus opinion. And that's what Amy Wu was talking about there.
You've been saying that for a while, that Apple, is it under-owned by investment firms? And there's some data on that I thought was really interesting, which actually confirms what you're talking about. Just to give you this, so Microsoft is 75% owned by investment companies. Apple share is 67%. So investment companies aren't as heavily sort of weighted in the Apple shares as they are in the Microsoft shares, which raises exactly your question. Are people going to have to play catch up, adding some momentum?
Well, they have to. And again, it's the active versus index fund. If you're an index fund and you own this stuff because you have to own it, and if it does well, up goes the index fund. And if you're running a little bit of advanced math here, but if you're running an R squared of 9.2 or 9.3, or dare I say 9.5, you got to own it. But your perspective says, do we really want to own X percent of name the big stock? And that's a tension you get into that we heard there from Amy Wu Silverman. This is way too much math for 613.
I was about to say R squared, 10 squared, 4, Q.
Chicago constitutional math. It's scary. Futures at -14. Much to talk about. A senator from Pennsylvania, a former senator, next. This is Bloomberg.
Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We didn't make a decision about July. I mean, of course, it came up in the meeting from time to time. I would say about July two things. One, decision hasn't been made. Two, I do expect that it will be a live meeting.
Chairman Powell there yesterday, really quite the comments there. I thought, historically, Mike McKee at 2 o'clock was absolutely stunning, calling it a super hawkish meeting, and on we went. And you reviewed it brilliantly yesterday, Lisa. You said, up went the markets, and then they pulled back. Sort of a little constructive move to the end, but the markets, there was a flightiness to it almost.
There's a bit of skepticism, in fairness, about whether they'll actually go through with the hawkish rhetoric or if this is jawboning as a monetary policy tool. And I think that that's really the takeaway that I've heard in a lot of the analytic notes.
What we're going to do is jump into a good conversation here on the politics of the moment for the United States of America. We do this, the futures -14, Dow futures -43. Patrick Toomey is one of our more interesting senators, a former senator. He is of Pennsylvania. It's his fault the Phillies lost, and he exited after that. And he joins us today. He's on the board of Apollo now, among other good duties here in his former career. What's the biggest difference of moving from the august Senate of Washington into the private space?
Well, there are a lot. Having control of your own schedule is one of them. The majority leader gets to decide when votes will occur, and you have to be on the floor in person to cast a vote. When you're out of the Senate, you have a lot more say in what you're doing and where.
That's a huge difference in the House right now, where there's 1 or 2 people away, and that changes it for Speaker McCarthy.
And that can happen in the Senate also.
Yeah.
How much do you kind of feel like you wouldn't necessarily run if the dynamics were the same now as they were when you started in politics?
Honestly, for me, I was in federal office for 18 years, 12 consecutive years in the Senate, and prior to that, a gap, and then 6 years in the House. For me, that was enough. I was ready to move on. I have no regrets. I mean, I really enjoyed and appreciated the chance to pursue the policies that I believed in, but I don't like the idea of being there forever for anybody, myself included. So I was ready to move on.
You're cut from a different cloth. I mean, there's Morgan Grenfell, and then you ran Rookie's Restaurant, Lehigh Valley, and all that. But what you're really acclaimed for is standing up to the former president and saying the behavior's not appropriate. We have seen an absolutely historic moment for the nation that will continue in the coming weeks and months. What is the best practice right now of centrist Republicans as they address this indictment in Miami?
Well, so I'm a conservative Republican, and my conservatism sort of requires me to call out the completely unacceptable and egregious behavior of the former president as it manifests itself periodically. Look, I think Republicans should call it for what it is. This is a completely unforced, unnecessary, outrageous abuse of the responsibility that the American people gave this president. He knew those documents didn't belong to him, but it wasn't just a sloppiness. It wasn't just a matter of, a few papers got mixed in with some of my mementos. It was lying about it. It was hiding it. It was suggesting to his lawyers that they make it disappear. It was discussing it in front of reporters, someone writing a book and recording this. And apparently, if we can believe the allegations, which I think they're there for a reason, it included very sensitive military secrets of the United States of America. So, as is often the case, Donald Trump is his own worst enemy. He makes a foolish mistake and then compounds it massively. And look, this is indefensible behavior.
I went back and looked at a September effort by Philip Bump in the Washington Post working off Pew Research, and I was thunderstruck at the countable research of how small MAGA is. It's not that great a part of the American pie. How does the broader sense of Republicans and independents not defend themselves, but just react, adjust, and move forward if MAGA's really not all that big? Boy, their megaphone's large.
Yeah, but the unfortunate reality in my mind is the president still, former president still does have a large level of support, and it's complicated, right? It's part of it is historical, part of it is a sense of the grievances that he fans. Part of it is the perception that he's being unfairly treated, and so even if he did something wrong, it's not a fair treatment. So it's complicated. Here's my theory: is the cumulative weight of all of the drama, all of the unnecessary misery, all of the lawsuits, the allegations, all of this is going to cause increasing numbers of Republicans, even if they've been sympathetic to Donald Trump, to say, okay, maybe he did a good job as president. We got to move on.
One of the rare things about you is that you can really dovetail from Washington to Wall Street, and that's sort of been your background, going back and forth. And we're talking about the politics of the moment at a time when Fed policy is going to dictate a lot on Wall Street for the next couple of years. How concerned are you growing, given the politicization of the inflation debate? How concerned are you that this Fed is not really convicted enough to go through with their mandate and get inflation back down to where it should be?
So I lean in the other direction. I think this Fed is very, very concerned about, their legacy, their reputation. They know that they got this badly wrong. They kept rates way too low, monetary policy way too easy for way too long. They established a flawed paradigm for determining when they would change. They got behind the curve. I think the risk is that they overdo it, and partly for the same reason that they went too far. In my conversations with Fed governors and senior staff, I was always surprised at how dismissive so many of them are about money supply, how dismissive they are about what Milton Friedman taught us, and how focused they are on things like inflation expectations rather than the 40% growth in M2 that they were responsible for in 18 months. So they might miss the collapse of the growth in M2, for instance, and misdiagnose what's going on, in my view. I think there's a great risk they go too far.
Are you agreeing with Elizabeth Warren?
I don't think so, because I think Elizabeth Warren was opposed to any kind of normalizing of interest rates, I think. May be a mischaracterization, but I think that's true. We now have positive real interest rates, I would argue, certainly if you're looking on a month-to-month basis. We have had money supply growth go to zero. We have the Fed shrinking its balance sheet. We have the Treasury's going to go out and absorb, $1 trillion worth of cash from the economy. So you put all that together and you look at how inflation has obviously rolled over. And I think we're probably on the right trajectory now. I'm not in the camp of easing by any means. I think the pause is probably the right thing to do. But you look at the dot plot and it looks as though they're going higher from here. So maybe that's the right call. I think the era is more likely to occur on excessive tightening.
Bloomberg surveillance has a great affection for politicians who come from a different territory than just pure politics as well. I was talking to our Greg Giroux, and he looks at the mess which is known as the coming presidential campaign. Yeah. And I would just suggest, sir, that you consider here in your private moments, private citizen moments, that we need a LaSalle Academy ticket. Now, I think Governor Raimondo and Pat Toomey could get together and bring Rhode Island to the nation. What's in the pixie dust at LaSalle Academy, Providence, Rhode Island, that gives us the Commerce Secretary and the former senator?
I think our Commerce Secretary is a very capable person, one of the more impressive members of the entire administration. But our worldviews still differ considerably. And I had a great experience at LaSalle Academy. It's a great school. But she and I won't be teaming up anytime soon.
What's the worldview you see at the debates of the Republican Party? I believe they start in August. What is that going to be
There's some very big ones, right? And this is really important. There's what is our role in the world? I mean, you have a wing of the party that thinks we shouldn't even be helping Ukrainians. I think that's crazy, but there's people who are advocating that. You have a wing of the party that wants to completely explicitly reject market capitalism and have central planning of industrial policy.
We're going to have to leave it there. After your Apollo board meeting, please come back and continue. I do want to talk to you about China. I think that's really front and center as well.
Thanks for having me.
He is with Apollo. Patrick Toomey is a former senator of Pennsylvania. Please stay with us. Futures -16, Dow futures -65. Lisa, I heard a Raimondo Toomey ticket there. I mean,
definitely not. Absolutely not.
Bloomberg Surveillance, good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Mr. Ferro, on assignment. Do we know which island?
Oh, honestly,
Sardinia?
Why do you call vacation assignment or holiday?
It's on assignment. Because I work all vacation. I wear my suit, my bow tie, and, I got my floaties on so I don't sink. And, I'm American. I work all vacation. That's what we do. We have a cell phone and, you work.
Do you have Hermes?
I have a memory. True story. True story.
Buddies.
I was talking to Colby Smith about this yesterday at the FT. I'm at Sea Island in Georgia studying for CFA Level 2 at the beach table or whatever of Sea Island while we're vacationing. True story.
Sounds fun.
It's
Sounds
just
like a fun
sick.
person.
Ferro does it better than we do. We welcome all of you on a really interesting Thursday after a truly historic Fed meeting. There's no other way about it. Futures negative 15. Yield space, the little 5 basis point move back up in the 2-year. Flighty, as I would call it. I do want to point out important curve inversion. 2-10 spread, let's call it negative 80 basis points. Now negative 92 basis points. Dare I say we can get one big figure, 1 full percentage point difference between the 2-year and the 10-year. We're not there yet.
No, and I'm watching the euro, and I'm partly because of what's going to happen with the ECB meeting later this morning, but also because of China and the additional rate cut that they announced overnight after weaker than expected retail sales, how much that's going to give Europe an additional pop on the heels of already this sort of baked-in belief in the past couple of weeks that they were slowing down.
I have to say, just out a headline, and this really shows a defensive strategy of retail, with retail sales coming out. Target, they boost their quarterly dividend. 1.9%. Why boost it? I guess they do it to keep a sequence of dividend increases going, like the Bank of New York back to 17, whatever. But nevertheless, there it is with a fractional boost as well. Why don't you set up the festivities from yesterday?
Well, yeah, it was quite a press conference. Basically, it seems like the theme has been the release comes out. It tends to have a hawkish tone, and Jay Powell takes the bite out of it gradually, as he says in his calm tone, that he's not committing to anything in July. Take a listen to some of the highlights.
The skip, I shouldn't call it a skip. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. I would just say it's a continuation of that process. We didn't make a decision about July. I do expect that it will be a live meeting. The conditions that we need to see in place to get inflation down are coming into place. But the process of that actually working on inflation is going to take some time. The risks to inflation are to the upside.
Basically trying to explain the awkward hawkish skip, hawkish pause, whatever you want to call it, Tom, as it's clear there is some disagreement on the committee about how much further they should go. I mean, that seems to be the theme when he said, we're not going to commit to anything in July.
Right.
The data will come in as the data comes in, whatever that means, and they will assess at that point.
My summary of this is simple, and I'm going to go to the Richard Clarida interview that Kriti Gupta had here in the last hour, because Clarida advanced the conversation 2 or 3 weeks ago in a blistering essay in The Economist, really important about where are we heading. Are we going above 2%? I want to do this quickly because we've got Will Kennedy on oil waiting. Jason Furman is at Harvard. He's one of our best economists, linking legit academic macroeconomics into policy making. He teaches Ec 10 at a small school in the Cambridge River. The Federal Open Market Committee is signaling a baby step away from a belief in low equilibrium interest rates. The median long FFR, I have no idea what that is, was unchanged at 2.5%, but the central tendency shifted up from 2.5 to 2.675, whatever that middle point is. All three of the lowest long-run dots shifted up. Expect more of this shift over time. And that's where the former vice chairman exactly is there's going to be a language here of an institution that can't visibly shift up.
Well, and we're talking about the neutral rate possibly being somewhat higher than what we've gotten accustomed to. And this goes to the heart of the question that a lot of people have. Why has this economy been so resilient to 500 basis points of rate hikes?
Right.
Is it just lag effects that haven't taken hold? Or is there something that's either less interest rate sensitive or more dynamic about the economy than anyone had previously realized?
And it fits into the demand question globally, that IMF survey of sluggish economics out 5 years. Will Kennedy is familiar with this, driving all our hydrocarbon coverage. And Will Kennedy this morning enjoying $68.87 West Texas Intermediate. Will, thank you so much for joining us. One of our great themes from Jeff Curry of Goldman Sachs, Amrita Sen, has been the idea that all of a sudden interest rates matter. We've got a higher interest rate regime, a legit coupon on short-term paper. How does that change the dialogue for Riyadh and the Kingdom of Saudi Arabia?
Well, I mean, obviously it is a destination for other, it provides a destination for money. It means that there may be less people putting their money into oil, and it may restrict the financial flows of money into oil. We do know that one of the things that we've seen in the oil market this year is that the paper market, the financial market, has felt much more bearish than OPEC producers and oil producers and people who are in the physical market think is justified. And people talk about that disconnect, whether that's true or not is for others to decide, but people talk about that disconnect between the paper market and the physical market, and that might be one reason.
Amrita Sen was really forceful about that yesterday or the day before, Will Kennedy, and she said the paper market, as you call it, the financialization of hydrocarbons just flat out has oil demand wrong. What is the actual Bloomberg reporting about OPEC plus oil demand?
Well, oil demand, there's a mixed picture. There are places where the demand is perhaps weaker than expected, a little off from what people expected. I mean, a lot of focus is on China right now, where people expected a huge surge in oil demand after the end of COVID restrictions early this year. And to some extent, we have seen some of that, but it probably hasn't been quite as strong as some people have expected. And in other parts of the industrial economy, which uses a lot of diesel, it has been weak. But there are other places where demand has been really, really strong. So it's a mixed picture. I think one thing that we want to take a look at over the next few months, perhaps, is the weather. It's very, very hot, and that's starting to have an impact.
I think we had some difficulties with Will Kennedy. Let's reestablish that as we go on. But Tom, I do wonder, as he's talking about the potential supply-demand dynamic, I keep thinking about what happened with Shell yesterday and the fact that not only did they increase their dividend, but they also doubled down on the fossil fuel kind of story that much more.
This is a huge deal.
And I mean, at what point is this them catching up to the shareholder activism that is definitely keeping American oil majors performing better than European ones? But how much is this them starting to potentially invest more in fossil fuels again? Do we start to get that story beginning anew?
The underlying thesis of those over $100 a barrel, let's say those that migrate back to $5 a gallon gasoline in America, is a burgeoning EM demand, a Pacific Rim demand, if you will, is a general statement. And that hasn't happened. I mean, I look at the J.P. Morgan call of a year ago, Christian Malik, which I thought was really informed, really articulate, really intelligent, and really wrong. And the issue is we didn't get that persistent above $100 a barrel oil because demand evaporated, the shock of COVID in China and that. And as it comes back, as Mr. Kennedy just pointed out, how do you sustain $68 West Texas Intermediate if China opens up? That's the arch question right now.
And what is the dynamic with electric vehicles and the electrification? Because right now we don't have a sense. Some people will say this is part of the reason for a lack of demand, and perhaps you're not necessarily seeing the translation into economic activity. And yet other people will say that's been a bit overstated, Tom.
Right now, on a day of ECB, we're going to jump from Will Kennedy. Thank you, Mr. Kennedy, for joining us this morning from Queen Victoria Street, to Gilles Mouek. He's chief economist at Axe Investment Managers, and not only a student of the monetary economics of Europe, but far more a student of the cultural economics of Europe. Gilles Mouek, thank you so much for joining us. How unified is Europe as we go to this ECB meeting? How far is the Bundesbank from the Uber doves of Frankfurt?
It's true that there's quite a bit of division emerging right now, because if you look at the distribution of inflation in the euro area, it's not what you could expect. If you focus on what I would call domestic inflation, services prices, for instance, countries in the south have been pretty well behaved. France has been pretty well behaved, and you can see the steepest increase in inflation. Not necessarily so much in Germany, but in a lot of northern European countries, Belgium, the Netherlands, and so forth. So we are in this strange situation where the countries whose national central bank governors are already of a hawkish disposition, facing a lot of inflation domestically, which makes them even more hawkish. Whereas in the southern European countries where inflation is less of a problem, obviously this fuels their more dovish dispositions. It's not enough to stop the ECB today, probably not enough to stop it in July, but I would certainly expect the debate to heat up this summer around the need to continue or not in September.
Gilles, how much does potential Chinese stimulus change the dynamic? We saw them cut one of their one-year rates last night or overnight in the U.S., just a touch, but it does seem to signal that they are ready to support the economy in a more significant way. Is that a significant boost to the European economy?
It should, yes, because big difference between Europe and the U.S., obviously, from this point of view is that Chinese traction matters quite a bit to us, especially for countries such as Germany. So yes, a stimulus in China would help. But what I think is interesting is that we've seen structural trends which are unfavorable, actually, to some European producers in China, irrespective of their growth rate. So if you look at the car industry, for instance, German car makers have for a long time been, the biggest car makers operating in China. It's no longer the case. They are being overtaken by domestic players. So yes, as usual, stronger Chinese demand would help, but it may not play the sort of absolutely crucial role that it would have played just 5 or 10 years ago.
Gilles Moek, thank you so much, with AXA Investment Managers on short notice today as we have the ECB in the 8 o'clock hour. Maria Tadeo in Frankfurt, and we'll, of course, give you the important press conference of President Lagarde here after those announcements. Lisa mentioned there was action in China overnight. We're going to do this now as a pre-brief before an important global Wall Street conversation with Leland Miller of China Beige Book. How does a society run, Lisa, on 20% plus youth unemployment? It's not American. I've never understood it.
A new record, exceeding what we saw in 2018, despite some of the strength in other areas. You've seen unemployment go down in other areas, but I believe it's 16 to 24-year-olds with a more than 20% unemployment rate. What kind of disputes does this raise between a population and their leaders at a time when they're trying to shift the dynamic, shift the economic model, while also keeping things afloat?
Bruce Kasman with us, of course, into the Fed meeting, head of economics globally for J.P. Morgan, and his Pacific Rim team, his China team, I should say, rather, modeled it out. And there's others that have been worse, but they put a 4X number on it, that China youth unemployment is 4 times larger than the aggregate unemployment within China. Clearly, that's not sustainable.
That's not sustainable, and yet a number of people are upgrading their expectation for how much growth could surprise to the upside in China based on them trying to stimulate.
I'm still hearing 5%.
Right, or even potentially more, that's the low end, because right now they're going to go back to the tools they know best, which is stimulate existing industries that some people would already say are bubblicious. I'm thinking of the housing industry in particular. How much does that support growth and inflation, or is it not? Is it simply just avoiding the worst of some sort of downturn?
This is really important with Leland Miller coming up, in that he's been more optimistic than most. And as we heard from a number of people, it's a domestic success, a domestic research for China, less so much us looking at cardboard boxes that say made in China. I mean, it's a domestic story.
And that's the reason why, perhaps, to Gilles Moek's point, it might not have the same kind of stimulative effect on other economies, including Europe, as it did 5 to 10 years ago.
We'll have to see. The euro, 108.42, an elevated euro over the last 3 or 4 days into the Lagarde press conference. Futures at -18. I'm going to call them quiescent here as we wait to get a Thursday started. How do we start? We start at claims at 8:30 and a report on America's retail sales. For Global Wall Street, command listening, Leland Miller, China Beige Book. We do that next.
As the chair indicated, the next meeting is live, which is Fed speak for saying that they could go. I think market pricing now more or less lines up with where we are, that given what we saw yesterday, they'll probably get that rate hike in at the July meeting.
The former vice chair of the Fed, Richard Clarida. We've been talking a lot by chance of Columbia Economics. Abby Joseph Cohen with us from their business school the other day. He, some would say, invented modern Columbia Economics as dean of the school. And of course, bringing Michael Woodford from Princeton is something people continue to talk about. But a lot of good work from Richard Clarida at PIMCO, at Columbia, and really driving forward the idea that there will be a new rate regime. That dovetails in, folks, to China. Right now, with futures -17, we're going to advance the conversation on China, and I'm not going to mince words. Leland Miller is an outlier with his granular analysis of China. Leland, you aggressively push against the China economic gloom. What are the gloomsters getting wrong?
Well, I think there's reason to be gloomy, but I think everything has to be relative at this point. So, these are probably some of the most difficult economic numbers that we've ever had to unravel, in over a decade. If you look at what we do know that the early expectations that there would be, a rally early in the year, those were wrong. If you look at what's happening with Q2, the idea that there's going to be a boom in Q2, those certainly look wrong too. So the question is there a recovery or are things falling apart? Well, if you look at this sequentially, you have been seeing some improvement month to month. Caixin improved 5 straight months. China Beige Book data improved 3 straight months. If you go into the industrial production data, it looks like there's sequential improvement. The retail sales numbers are really hard to decipher because they seem to be moving these around from year to year. But you do seem to be seeing some elements of improvement. You're just not seeing the recovery everybody's expecting, which has made everybody very pessimistic. So it's really about framing, what the expectations were, what they are for the rest of the quarter, and then going based on that.
The PBOC responded after getting these disappointing retail sales figures over the past 12 hours. They cut this rate on the one-year loan aspect of their portfolio by 10 basis points. And that's not necessarily a significant move. This follows another very small move earlier in the week. What does this signal about what they are prepared to do in terms of stimulus?
I don't think it signals that much. I think in and of itself, it's a signal that they understand that the data are not where they need to be or not where people expected them to be. But here's the problem. People, every time they see weak data, they expect stimulus, big stimulus. Some other stimulus is coming down the road to save them. This is like a time machine. You go back to 2020. 2021, 2022, now it's 2023. We're having the same type of conversation we've had for years. The Chinese data overall getting weaker. Expectations for stimulus stay the same. Look, they are unlikely to do any type of big stimulus. They're cutting baby rates. They're not going to have much of an effect because this is a demand question. The big question is, do they dive back down into the old school, let's build a bunch of bridges, let's build a bunch of towns, infrastructure investment? I think that's still very unlikely. Nothing that we're seeing in China suggests that they want to go back on that model, that they have different priorities right now. So I think that these signals are sending some sentiment boost to markets because the data are relatively weak. But I don't think that they foretell a big movement towards bigger stimulus.
Leland, there's sort of a conflicted picture here then. On one hand, you don't think the data is as dire or some of the expectations are as dire as people expect it to be in terms of the deceleration of the Chinese economy. On the other, you don't expect stimulus to come and save the day and propel growth substantially above 5%. What is the new growth paradigm? How much will China's GDP expand this year and then going forward, the new normal?
Well, look, our June data, which we get in 2 weeks, are probably, I'm anticipating these are going to be the most interesting data we've seen in over a decade because June is whether the second quarter growth can be saved and whether they can get anywhere near the 5% number. Keep in mind, they're coming off an extremely poor base in 2022. So hitting some of these numbers for the second quarter, for instance, are not as hard as people think. But again, what's the big lesson here? The lesson is they are just not prioritizing hitting the levels of growth that people on Wall Street are telling us that they're going to hit. They are trying to, they're trying to move forward, restrain themselves from bigger stimulus. Right. They're reprioritizing the economy in terms of, national security, different priority set.
Leland Miller, Jonathan Spence 101 is when in doubt as a totalitarian regime employ the masses. I'm looking in February, and I'm sure you've read this in Chinese, measures for the administration of national work relief. Does all this come down to the primal scream that the totalitarian elites in Beijing have to employ millions of unemployed, millions of low wage, this immense labor pressure that's been there for 50 years?
Well, labor pressure is at the center of this because, you know, the talk for years now has been that China needs to restructure their society from investment driven to consumption driven, you know, to from old type of the economic model to a new type of economic model. You know, that's a restructuring of jobs along the way, and so you need to make sure you keep people employed. So this is an issue. You have some issues in the labor market that'll be helpful over the years with falling working population, et cetera. It's going to be easier to do, but this is still a grand transition for them. So
right.
They've got enormous challenges going forward trying to make growth work.
I mean, they get the challenges there that were there 10 years ago, 20 years ago. I personally observed them in Shanghai, and I found it extraordinary to see basically serfdom in modern pseudo-capitalism, if you will. What's the Leland Miller unemployment rate from Chengdu to Beijing?
Oh, wow. You know, a lot of this is the methodology, how to use it. I mean, people look at this youth unemployment rate, which is awful. It's bad news and it's scary. It's done very differently than the way it's done in the United States. For instance, I mean, you're unemployed. If you're unemployed, you're unemployed. You're not, there's different waiting times and other things for being categorized. It does show there's a problem. I don't think it's the key problem that they're looking at. I think what they need to do is reinstill some level of confidence, not through stimulus, but through organic policies. And they need to boost demand, because right now there needs to be a domestic demand story that's able to spur this recovery. So they're in a weird position where they're not getting the organic recovery so far that they were expecting, but they're also a lot less likely to be going down the stimulus route, at least compared to what most people around the globe think. So they're in a position where the pressure's on.
Meanwhile, we see that Tony Blinken, Secretary of State, is heading over to Beijing to get a sense of whether they can really ease some of the tensions that have been escalating, ratcheting up between the U.S. and China. What are you looking for in terms of understanding the points of leverage and what China wants in terms of international participation from these meetings?
I'm not sure they want much. I mean, one of the sources of leverage for the Chinese right now is the fact that they don't want to interact with their American opposites. They don't want to answer military hotlines. They want to say, look, if you're going to be rough on us from an international relations standpoint, then we're going to ignore you. And that raises the risk for everybody that there could be some sort of misunderstanding or confrontation. I think that works for China's favor in their minds, at least. So I don't think they want much of it. Better communications, more communications is a good thing. But I don't think that this meeting is going to solve anything.
I look, Leland, you know, just one final quick question here on the solidity of the federal administration in Beijing. I mean, everybody makes a deal, you know, premier president for life, whatever Xi is, but how stable are they? What support do they have from the city's mayors and from the regional organization of the Communist Party?
Well, China's a black box. I mean, that's still true. But there's nothing that we're seeing that suggests that the Chinese Communist Party, despite all these structural headwinds, despite weak economic growth, despite a challenging international environment, doesn't have the support of the people, that there's any type of pushback against Xi Jinping. We're just not seeing that. So obviously underneath the system, there's no pressure valve like there is in a democracy to throw the bums out. But look, it's hard to see any type of specific political stress in the system, although there's certainly lots of economic stress.
Leland Miller, thank you for the brief. He is with China Beige Book. Can't say enough about the granular work that we see there. Lisa, I remember standing off the Bund in Shanghai and watching they were building whatever skyscraper of the moment it was. And it was a labor component that I had never witnessed in my life. And my stereotype would be they brought him in from the hinterlands to build a skyscraper. But that's been the MO for 50 years, I'd say. Why has that ended? I don't think it's ended. Well,
it's true, and that might be the one tool that they go back to. But there is this fear about the leverage that's built up in the system and this desire to right-size it. And how much can they support a property market if they just keep building? Chinese yuan rounded up 7.16, a devaluation of the yuan over the recent months. We'll see where that goes. Steve Englander talking 7.30 at Standard Chartered Bank. Futures at -18, the ECB in the 8 o'clock hour. American economic data in the 8 o'clock hour. This is Bloomberg Surveillance.
Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings.
Jay Powell's made it really clear that right now the priority is inflation.
This is about really pushing back hard against the recession consensus.
They succeeded in what we expected, namely delivering a hawkish skip.
We expect them to raise rates both in July and in September and to get to that 0.5%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Mr. Ferro on assignment, 3 islands in Italy. Sounds good. 1 week, 1 island, 1 week, the next. Sardinia looks to be awesome this time of year.
Yeah, these are quite nice assignments, I will say. I will call it vacation. I'll call it
He's
what it
British.
is.
What can I say? Well, anyways, thank you for joining us today, and we're still recovering. Lisa and I, we stay. Somebody said, "Where do you stay?" And I said, "Well,
I get this
we stay, frankly, right in the studio, and it's just as simple as that." But it was exhausting yesterday because it was unexpected, and you see it in the market reaction. And I go right back, Lisa, to Michael McKee at 200. Not the tension in Mike's voice, but just the understanding of the historic moment we saw yesterday.
Super hawkish skip, although perhaps don't call it a skip anymore because Jay Powell seemed to not like that. The takeaway for me was there is now a tension between what the Fed says and what the Fed does. They want to express hawkishness to get the markets to not necessarily loosen conditions, essentially loosen credit conditions for them and move away from what they want. On the other hand, it is unclear to me the conviction that they have to really raise rates by another 50 basis points.
Going to link it into retail sales coming up today. We've got claims, and that'll be interesting. We did have not a jump condition, but nevertheless lifting claims last week on the weekly data, but the monthly retail sales as a nominal statistic will be interesting to see.
Especially because car sales and used car sales have been coming in a little bit, and that's going to really distort the numbers, not only on the retail sales, but also on the inflation front. One of the feeders into the people who believe there is going to be disinflation. Is it year-over-year effects, or are people just basically saying, I'm not going to pay 12% interest rates to buy a car, right? To take out an $80,000 loan to buy some sort of SUV.
We're going to have to see. Excuse me. What I would suggest more than anything is the Fed speakers coming up, including 3, I believe, tomorrow. Lisa will give that to you tomorrow morning, Bullard and company. It's going to just be amazing to see how different presidents, different governors react to what we witnessed yesterday.
And how much dispersion there is among them. Again, I keep going back to herding cats. This was a consensus statement with a lot of tension underneath it, basically. Right. People disagreeing with one another.
For those of you that missed the rally, we've got an important guest coming up, so I'm going to race through the data. Futures negative 16, the VIX at a 14.13. We had a 13 handle showing equity optimism yesterday. 10-year yield, elevated yield today, 4 basis points, 3.82%. We're distant from 4% there. Key item, curve inversion, substantial curve inversion off of what Chairman Powell said yesterday. The vanilla spread, 92 basis points, which I guess you could round down to a negative 100. We're not there yet. Oil, 69.14. Thank you to Will Kennedy for the brief on OPEC dollar stability as well. And briefing forward, we're going to talk to somebody who actually has a pulse on the American economy.
Well, that to me is exactly where I wanted to go. The most interesting aspect of yesterday's market action to me was the strength in the NASDAQ. And this wasn't an issue of interest rate sensitivity. It was dynamism. It was the idea of secular growth. John Lawler of Ford, CFO, is going to be speaking with us coming up in about a half an hour, followed by Megan Green, who is at Kroll and Brown, but also she is going to be joining the ECB as an external member of the Monetary Policy Committee. But John Lawler to talk about Tesla and some of their charging facilities, what this means as we expand. 8:15 a.m., we do get that ECB rate decision, followed by an 8:45 a.m. press conference with Christine Lagarde, watching the euro to see that dynamic and how it plays out. And 8:30 a.m., the data dump, which includes initial jobless claims, always important with the Fed's emphasis on the labor market. But U.S. retail sales going to be really key to see how long the U.S. consumer can continue to surprise to the upside by just deploying cash well beyond what anyone expected, Tom.
And maybe it shows the two Americas out there. One group flat on their back and really struggling, and another group spending as we go. Again, futures negative 17. For Global Wall Street, maybe this is a value, but particularly for all of you that just simply missed the great bull market coming off the October lows, this is an important brief. Eric Knudsen joins us right now. multi-asset class CIO at Neuberger Berman. That's a loaded set of syllables for someone with a lot of experience. Have we been here before with the first leg of a bull market, and now what?
Yeah, so what we're focused on right now is the difference between the short term, which we still think is reasonably positive for equities, kind of carrying on with what we've seen over the last 6 months, but we think broadening out away from the 7 big stocks that have been leading the market versus the medium term, let's say 18 months, where we think that the pressures of higher rates and sticky inflation and central banks longer rather than higher is going to start putting pressure on equities. So we want to find ways to participate right now in this market, but not necessarily by chasing, the 7 AI darlings, and find areas of the market where, frankly, AI is going to also have a big impact, but that's not priced yet.
The heritage of Neuberger Berman is individual stock selection, huge acclaim over the acquisition of Whole Foods and Amazon years ago, and away from indexing, if you will. I know you're going to tell me there's value in active management right now, but what kind of active management? Is it stock-specific, sector-specific? What's the factor nuance of doing active management right now?
Yeah, the way we approach it when we're building our multi-asset portfolios is we want a component of our portfolio to simply be our analysts' best ideas, locked down to the index. So we're not taking factor bets, sector bets, underweights, and small cap versus large cap, just the best ideas managed against this S&P and the Russell 1000. And that approach has done really well this year because our analysts like the NVIDIA's, one of our, highest rated stocks, Microsoft, et cetera.
He only mentions the ones that rocket.
Of course.
What was the dog in that group?
I'll tell you, we didn't own Tesla. How's that? We didn't own Meta. No, but then we complement that with a set of exposures that really are meant to capture factors that are compensated over the long term. So better value, better quality, higher dividend, lower risk. That approach has not worked so far this year. It worked great last year. It has not worked this year because you're just under owning those big cap stocks that have been really leading the market.
To build on what you're talking about with respect to broadening out and seeing other areas that perhaps haven't gotten bid up but still will benefit from the same trends, how much does this still remain within the sphere of tech, rather than broadening out to other areas like smaller companies, like consumer discretionary? And I think about what Amy Wu Silverman was saying, which is maybe the secular growth story really is just the tech story, and the rest are going to struggle, especially in a new rate regime.
It's a key question, and I thought her comments were great. By the way, in a tactical way, we're playing kind of the big cap tech stocks is by owning calls, buying some calls on the S&P, cheap vol, take the exposure that way, take it cheaply, and then focus away from necessarily tech, away from the names where AI is already baked in. I think it was Bill Gates who said tech or AI is going to be exaggerated. The effect's going to be exaggerated for the next 2 years, but underestimated for the following 10. And a lot of our research says that the biggest impact is going to be on areas away from the big cap tech and even the tech stocks. Main Street companies, Ford, logistics companies, marketing companies, where this is going to transform their businesses, and that is not yet reflected in the price.
At the same time, people have also moved away from big tech as interest rate sensitive, and I do wonder on a broader level, if we are heading toward a higher rate regime, whether that does take away from some of the potential returns on equities, or whether people are shifting back to this belief it is completely separate, there's a different growth story, and you got to get out of that kind of mindset.
Yeah, I think one of our biggest observations this year is that the Fed funds rate and QT has had no impact on markets. So we spend all this time talking about what's the Fed's move and what did they say and parsing Powell's speech. We thought the market reaction from 2 to 230 was about right, and then you get the rally, and it's like, oh, no, it doesn't matter. I think what we would suggest is, in terms of rates, you need to look out a little further and look into 2025 and the long-term rate. The Fed still has the long-term rate at 2.5. That's the part that we think needs to change. As recently as 2013, the long-term plot was 3+.
Yeah, well, no, this is exactly what Tom has been talking about, right? Yeah. This is exactly the point that we heard earlier, that people are saying that's going to go up to 2.6, 2.7, 2.8%, that we are entering a higher rate, sort of neutral rate regime. What does that mean for equity returns?
It's pressure over the medium term. It's going to put pressure on valuations. It's going to put pressure on margins. And so that's why, even as we're trying to participate in this environment on a 6 to 18 month time horizon, we're more cautious, and we're really trying to trade off is there enough liquidity in the system? Does AI make enough difference to offset what we think is likely a higher structural inflation and higher structural real rate and term rate environment?
What is the value of owning Walmart with a 25 multiple? You get a nominal GDP or just sub-nominal GDP revenue pop. You've got the margin battle. Let's say Walmart does better than most retail. But I can't figure out how I get to a 25 multiple on an income statement that looks like that.
Yeah, so I leave the individual stock analysis to my
general,
smart,
the 45 other Walmarts.
My wicked smart other colleagues. So we wouldn't want to own it at 25. There is value out there. I mean, the S&P is trading at 19 times, but if you strip out the big 7, it's trading at 17 times. I mean, it's not cheap, but that's reasonable, especially with some of the tailwinds we have in the short term here. So rather than Walmart at 25, we want to look at some other stocks that can benefit from this environment with some better valuations.
Eric, thank you so much. Eric Knudsen with us with Neuberger Berman today. Just decades of experience here of battling away from an intelligent 60-40. Like, what do you actually allocate to or change
Wicked
along
smart.
the way?
I just keep thinking about that. Wicked smart.
Speaking
of Red Sox,
when the Red Sox are in last place, they're not wicked smart. Wicked painful is
probably the more
is.
likely way. This to me is really interesting, though. How do you play a market that has one story that is so different from the overall story, but that story is dominant in terms of the index valuation? And that, to me, is the sort of tension of AI right now.
I'd urge everyone to go back and look at the digital file on Abby Joseph Cohen from Columbia Business School, where she made very clear there's an Abby Joseph Cohen optimism, but it is an optimism of rotation. That you've just got to look at other stuff.
She also is trained as a computer scientist, and she's been speaking with AI specialists. And there's a real question, and I got to be honest, I talk about this at home with the little ones who are trying to use ChatGPT to write their papers, and the limitations on it is they still are significant.
On a data
Thank
check,
goodness.
the VIX of 14.16 on the VIX, and the 10-year yield 3.82%, up a good 4 basis points as well. And we're watching oil under 70 a barrel, 69.02 a barrel. If you're joining the program right now, the S&P is down 0.4%.
You know, Tom, I've been looking right now at one story that crossed that struck me about Deutsche Bank, and basically saying that trading revenue is going to drop as much as 20%. And this follows what we saw from Perella Weinberg coming out and possibly cutting, what was it? It was 40 people, but it was a significant portion of their staff. And I just wonder at this point, yes, that was a culling of the herd and getting ready to hire. But I just wonder if we start seeing more of this. Citigroup coming out yesterday, cutting 1,600 people. How much is this going to kind of percolate as activity starts to slow?
Stephen Aarons in Frankfurt reporting, and Bloomberg reports Deutsche Bank says trading revenue to drop as much as 20%. I think the key thing here is not each individual story, but the daily occurrence of it sliding into a summer where good people are trying to plan for the autumn and into next year.
Yeah, so to me, the other story is just, we talked about AI and the secular kind of shift in banks. What does that mean? If you have to shift the composition of your people, I'm not saying it's going to wholesale remove swaths of employees. Somebody else can say that. To me, the question is, does it change the role, right? It just sort of changes what the job description is if you're trying to increase some of your use of tech. Just to give you a sense, Citigroup's CFO came out yesterday and said that there will be an expense of about $400 million this quarter as they cut 1,600.
Well, 1,600, but I've seen other numbers that are much, much larger. What it amounts to is a sea change here in Wall Street. We'll be following that through the summer as well. I'm looking for a robot to replace a CFA. I just don't see that. I mean, I'm a little biased.
I'm looking for a robot to replace me, particularly at night when I have to, make dinner and clean up.
Equipment leasing, accounting, ChatGPT, it really works out. On the Euro, this day of the ECB, Jordan Rochester. We do that at 8 a.m.
The skip, I shouldn't call it a skip. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. I would just say it's a continuation of that process. We didn't make a decision about July. I do expect that it will be a live meeting. The conditions that we need to see in place to get inflation down are coming into place. But the process of that actually working on inflation is going to take some time. The risks to inflation are to the upside.
And I admit there was a point where I just burst out laughing. He was struggling so hard with skip and pause. It was, I can't remember who the question was from, but it was just on the edge of comedic as well. Lisa, this has gotten so silly. I mean, the language, I remember V-shape was unusual. That sounds like it's biblical compared to the silliness we're doing now.
It's really awkward. And this is what Rich Clarida said. This is so awkward. They want to basically do one thing and say another and hope that people look what they're saying, but not what they're doing, and that they follow that guidance, and it can potentially push markets. It's just a really uncomfortable kind of moment where they're really depending a lot, letting their credibility do a lot of the heavy lifting.
We pick up the debris this morning, this Thursday morning, and of course, lots going on. We've got economic data at 8:30, claims onto retail sales, and Mr. McKee, I believe, will be with us to dissect that. We've got markets negative 18. And far more importantly, at least what I think has been unspoken here, even by Jean Mouek earlier with AXA, is how does the ECB, and particularly the Lagarde press conference, adapt and adjust to skip and pause? She's got to be asked, how close are you to a skip, to a pause?
And she probably will come out and say, we still have substantial work to do while raising rates potentially to 3.5% for the ECB area. To me, that's shocking considering where we're coming from. This comes at a time where they don't necessarily have the pressure to do the pause yet or the skip, right? So they can continue doing this without a lot of disagreement. In the U.S., to me, the big tension is that risk assets continue rallying, even on the heels of a hawkish pause, even on the heels of something that could potentially end up tightening conditions that much more.
It's a two-part world. It's a longer duration world, and you can decide where your long duration kicks in. And, you know, it can be 10 years, it can be 7 years, 5 years. There's even some people in the short-term space where long duration is 12 months, like our next guest.
Well, and that's actually part of the issue, right? You see that in credit, that it is shortening up in terms of duration, the refinancing risk coming that much more into focus. Joining us, our next guest, Woody Caesar, Global Head of Strategy at Credit Sites, and that's exactly where I wanted to go. Right? Are we basically, the long and lag effects, are people now understating them because they've gotten so sick of waiting and waiting and waiting? And the refinancing costs are going to start to bite.
Yeah, this is a really tricky space for the Fed and the market to be in because the market moves so fast and the data does not move that fast. And this is where patience really has to kick in on the Fed side of things and also on the market side of things. We have seen some slow progress on inflation. But at the same time, we've seen a massive increase in borrowing costs. Now, the good news is markets are open, even for high yield companies, even for some of those more storied or stressed companies that were basically priced out of the market last year. But the question of how sustainable is this capital structure at 7, 8, 9, 10% interest costs versus, 3, 4, 5% just a couple of years ago is definitely one that has a lot of investors in the credit market really trying to figure out which companies do we align with.
In the past couple of months, you've been talking about how you are overweight investment grade and high yield. That has been a fantastic bet. We're seeing high yield bonds rally since March 24th by 3.3%, which is significant for high yield bonds. Are you fading that now?
We're not fading it quite yet. I will say that given the kind of dance that Powell did at the press conference yesterday and the hawkish pause, we feel like the probability of a hard landing is modestly increasing. But when we look at the all-in yield for both investment grade and high yield, and the reality that if a hard landing manifests, total returns are just going to be amazingly good in both investment grade and high yield, you have this nice balance of kind of downside protection and incremental carry that leaves us pretty constructive on corporate credit, especially when we look at it relative to things like equities.
What will be the behavior of the markets? This is the meat and potatoes of what Credit Sites does. What's the behavior market if we don't get what you just said and we go the other way and the new money market fund is 5.85%, dare I say 6%? How do we behave?
Yeah, so this has been the big headwind for credit, right? Every client is sitting on a ton of cash. They can be rolling 3-month treasury bills north of 5%. Feels like a pretty good opportunity, especially when you're waiting for spreads to blow out again. And I think that that's one of the things that investors really need to pay attention to, because so long as there's cash, so long as people are waiting, that really mitigates spreads blowing out significantly, absent some sort of, regional banking crisis 2.0, which is definitely not in our base case expectation.
But if we get a short-term higher yield, which I would say is against consensus right now, I guess it's price down, yield up. But what you do is you have massive carry pickup. I mean, it's carry like in my ute. All of a sudden happens. How do we behave when we have that?
Well, it kind of depends on what the longer term view is. I would say for investors focused on the 12-month horizon, that carry feels pretty attractive, especially if it's yields up in the next 3 to 6 months, and then at some point in 2024 we actually are cutting rates back down towards whatever that new neutral is, in 2025. If it's, more of there's some sort of policy mistake, the carry doesn't feel quite as good, but the liquidity of the markets does allow you some opportunities to get in and out relatively quickly.
You were talking about how credit conditions are pretty good, that even high-yield companies can access the market. This speaks to the sort of loosening in credit conditions that really flies against this idea of a banking crisis. When does that stop? What is your fear of there potentially being some sort of fissure, especially if growth slows, that changes the dynamic about whether companies can keep paying?
Yeah, so I think that you need to see a real deceleration on the consumer side of the equation. We've seen so much just excess savings and, revenge travel and all the discretionary spending really kind of propping things up. And at the same time, the labor market is holding in relatively well. And the problem that the Fed has in terms of their messaging is they are trying to message recessionary type behavior to slow things down without actually causing a recession. And that's a really, really tricky tightrope to navigate.
And North Carolina Child Protective Service emailed in, and they said, we got a problem. Miss Caesar is going to her rising third grader. Is Abigail?
Yes, Abigail.
Abigail. Are you really forcing her to use an HP 12C at the dining room table to learn compound interest?
We do talk compound interest at the dinner table.
Do you use a TI or an HP 12C with her there? The school's using TI, but I'm assuming that someone from credit sites goes right to reverse Polish notation, right?
We actually just pull out the abacus.
Do you get the abacus? Good. My father had the slide rule. The abacus is better and more safe. Winnie Caesar, thank you so much. They bring their kids up here. Let's go to New York and see Bloomberg surveillance. That's why they come, right?
It's fantastic. We welcome it. It's always great to get some fresh blood in that can potentially be an intern next year.
You got that fourth grade internship. I can see it happening right now. Futures -18, Dow futures at -79. Lisa, what on the screen gets your attention today? Equities, bonds, currencies, commodities.
I'm watching the euro today because I want to understand the difference between the hawkish pause of the Fed and what the ECB does and what they guide forward. How much does this sort of dovetail into the question around China and stimulus and possibly some sort of surprise to the upside with respect to growth there? How much could this be sort of a catalytic moment, especially given that dollar weakness has really fueled the international bet and some of the other risk-taking activity that we've seen so far?
We've had a gift of energy and a barrel of oil. They have a horrific war heating up, it appears to be, by every report. I wonder how energy and cheaper net gas, cheaper oil will fold into her discussion. Does she use it as a tangential thing off to the side, or is it tangible to their outlook? I don't know.
Does it reduce inflationary pressures, or quite the opposite, increase discretionary spending and allow people to keep going about and traveling? The tension between Germany and Southern Europe, to me, is very interesting because suddenly it's a sort of reversal of the normal roles that we've seen in the past.
I strongly take your point on that. And speaking with the finance minister of Spain, as we did the other day, there's a buoyancy there away from Germany. It's widely understood that the needle's moving on Italy because Ferro's over there in 3 islands. I mean, he's single-handedly moving GDP in Sardinia.
On assignment, because we don't take vacation here on surveillance, right, Tom?
I think Draghi wrote him a note, thank you, or something.
No wonder you want all those road trips.
John Ferro on assignment. We look forward to seeing him on Monday as well. Futures -18, Dow futures -81. Stay with us. An important conversation with Dearborn next. Bloomberg Surveillance, good morning, everyone, on equities, bonds, currencies, commodities. 1 hour away from really important economic data. I'd say that yesterday at 1 p.m., even more so at 2:05 p.m. This data, particularly on retail sales, really folds right into the debate that's going to be engendered tomorrow. Bullard, Barkin, and somebody else, Waller, I think, speak tomorrow off of the bombshell Fed meeting yesterday.
Since when do you follow Fed speak?
I don't,
every time I say it, you come out and you say, no one cares. And now today you're just trying to goad me on.
I did not see this in the zeitgeist yesterday, and I think McKee nailed it. Yesterday was historic. It was an absolutely original moment. You saw that with market movement. You saw that with the intensity of the press conference. There was no screwing around in the press conference yesterday. I mean, he was reading off the script and identifying where they are in this post-pandemic unusual time.
That's technical CFA language for what transpired in the press conference. What we're seeing today is a little bit of a different tone, particularly in the tech stocks that rallied in the after hours of Fed Chair Jay Powell's press conference. We are seeing a bit of a shift there with NVIDIA and Tesla actually declining. What I find interesting today is a little bit of softness ahead of the ECB, perhaps looking for some sort of shift there. But Tesla down almost 3% after 13 straight days of gains that added more than $200 billion of market valuation to that company. NVIDIA also just slightly soggy. I mean, again, no one's going to cry because they've gotten so many gains so far this year, down 1.3%. And Alibaba and Baidu both up more than 1%. And this comes on the heels of potential stimulus, maybe.
Really?
From
So
China.
they reacted to the Chinese news.
Well, and I wonder how much you're seeing that in Europe as well, with the reaction of the expectation of rate hikes shifting higher in terms of the total cycle as a result of China possibly being more dynamic than people previously thought.
And I overlay that on OECD views, which is maybe more optimistic than IMF views, but they're calling for this global slowdown near global recession. And the fact is, governments will adjust, as we've seen. What's important here, not one time from China, but what, 3 times recently? And Leland Miller with some real optimism that China will make the adjustments.
But let's be clear, this isn't wholesale. Let's just load the boat and start building new cities that nobody's going to live in.
We're scrupulous at Bloomberg Surveillance about full disclosure. So I'm going to give you a full disclosure now. In the old days, in our youth, maybe one guy within a zip code had a Renault or a Fiat or something sexy from Europe. Maybe the rich guy had a Citroën. And everybody else either had something from Generous Motors or the people of Dearborn. And you were either a GM or a Ford family. Let me make clear the Keene household was a Ford family. So this is a joy to talk to the gentleman from Ames, Iowa and University of Iowa, from Iowa City and University of Iowa. John Lawler joins us. He's the Chief Financial Officer for the Ford family, Ford and all that Dearborn stands for. Are the Fords still involved in the company?
Oh, absolutely. Very much so. Bill's very active, and it's wonderful to have him there because he has such a rich history and experience with the industry and the company, and he really sets the tone about our values and what we stand for. So it's wonderful.
I was in Detroit with, I think Steve Ratner was a car czar at the time, and you people took a different path from everybody else. Do you see the outcome of the courage you had not to take the path everybody else took? Does that still with you this many years on?
Yeah, there's a lot of pride in the company about that, in running the business well, and what that means for us. And you see it in where we're approaching our product lineup, the iconic products that Ford stands for and the rich heritage there. It's very much a part of who we are and what we do. And working through the financial crisis the way we did is a pride point for the company.
How do you distinguish yourself in the hottest growing area of electric vehicles at a time when it seems increasingly as though the Fords and the GMs of the world are going to manufacture the cars, and Tesla is going to both manufacture the cars and provide the charging networks?
Well, it's interesting because we see ourselves as a first mover in that we have 3 great vehicles on the road today. We're learning a great amount from those customers. We're already working on our 2nd generation electric vehicle, and we've started working on our 3rd generation. So we see ourselves out in front. Now, when we move to charging, the move we made last week or 2 weeks ago with Tesla is really good for the customers, and that's what it's about. It opens up about 12,000 additional charging stations for them. It allows them to scale that very quickly, us to scale that very quickly, and it's all about making life easier for the customer. And when we do that, it's good for
Okay,
Ford.
but our Keith Naughton makes very clear in Detroit that you're giving it away to Tesla. How much did you give away to Tesla here with this agreement?
Well, we don't see ourselves giving it away to Tesla. What we're doing is we're opening up the Tesla network, working with Tesla and providing that for our customers. So I think it's about giving them what they need and the convenience of having more options from a charging standpoint.
So just to sort of put a bow on it, is Tesla the industry standard when it comes to charging now?
Tesla has a very good charging network, and it's good for our customers to be able to participate in that.
You talk about the adoption of electric vehicles, and people have noted that it's been a lot slower, that you make electric vehicles, but people still want to buy SUVs that run on gasoline. You see it coming to about 30% of the industry by 2030. That's different from what, the president has put out there and others seeing it adopt perhaps a little bit more quickly. Why is there this differential? Why do you think there's a sticking point that's going to keep it from really getting to that point?
Well, when you look at it, ultimately, of course, the consumer decides. And when you look at our business, we have three strong businesses within Ford. We have a strong, what we call ICE business, or Ford Blue, which is gas and diesel. We have the electric business, which is a startup, and then we have our commercial business. And we see that gasoline vehicles, powered vehicles, they're going to be around for a while, especially the vehicles that we lean into, pickup trucks, SUVs. And those, a lot of them do work or have different enthusiast activities that they do. So we see that continuing for quite a while. So we see strength in all three of those businesses. Mm-hmm. We have two very strong businesses while we have this startup. And the future, of course, is EV, but the consumer will ultimately decide that adoption rate. And right now we're moving into, from early adopters to early majority. And I don't think anybody knows how that transition curve is going to take place. And we're watching that very closely.
When you were at Knox and the University of Iowa, you learned about persistency of free cash flow, which leads into total return. The auto industry has a flat-out mediocre total return over 10 years. You've got some recent 5-year dividend growth that's pretty snappy and all that. The airline shifted to a more persistent financial model of success. Can Ford and the auto industry do that? Can you move to a more persistent free cash flow that generates high single-digit total return?
Absolutely. That's what we're focused on.
How are you going to do it?
Well, first of all, it's leveraging the two real strong businesses that we have in Blue and Pro. And the great thing about the industry right now in this transition is the ability to attach to the consumer, because these vehicles that we're putting out there now are connected, and we can create a lifetime relationship with those customers, build services and experiences that's accretive to positive cash flow and is accretive to the business.
How much can you keep raising prices at a time where you're starting to see some real pushback and actually falling car prices on the margins?
Yeah, if you look at this year, when you look at prices, they're down slightly. I think the path of continuously increasing prices is behind us, and we're going to have to manage that. In certain areas, we'll be able to price new products where you have strengths, differentiation. But overall, I think the industry's past the large increases that we saw over the last couple of years, largely driven by inflation. And so now we need to look at affordability and where's affordability for the consumer and manage that very carefully.
Do you feel like you have to respond to price cuts that have been reversed by Tesla, but price cuts in the industry just more generally, that there is this competitive momentum downward in terms of trying to cater to a consumer that's borrowing at a pretty high rate relative to history?
Well, when you look at it, I think you have to look at it by vehicle and by segment, and where the competition is, where you're at with the strength of your product, the differentiation that you can provide, where's the natural demand for that product. And right now, we have a lot of new product on the road, especially in the Blue business as well as the Pro business. And what we see there is that with the new product and the differentiation and the iconic brands that we have pricing power and we have high demand.
What's the proportion and how has it shifted of cars that are bought in cash rather than credit over the past 5 years? And I ask this in terms of the haves and the have-nots. People with money and cash are buying the cars and fueling the demand, fueling the sales that you're getting, and people on credit are disappearing.
We haven't seen a large shift in the mix between cash purchases and purchases through credit. We have a very strong credit company in Ford Credit, and they do a great job working with our customers. And what we have is we have a proprietary credit scoring model. And so we'll buy customers that others might say aren't purchasable or aren't qualified, and we have a very good record with that. And you see that our credit losses or our severity, it's not increasing; it's still low. So I think we have a really good model in how we do that.
The Bloomberg terminal says you've got an 8 multiple to be kind on a forward view. That's just subpar in this environment. What is a multiple you perceive Ford should earn by the market?
It is subpar. If you look at the industry has been, contained in this box, which is very low.
That's the heart of the matter.
Yep.
How do you get out of the box?
I think it's execution. It's capital efficiency, really watching where you are from capital and EBITDA over capital expenditures, and then consistently delivering. And now with the industry and the ability to expand our TAM and expand our business with our customers, we have an opportunity to break out, and we're going to do that.
It's not good enough for Keith Naughton. He wants to know the number you perceive. Should Ford be a 15 multiple company, 12 multiple? Can you be, like Apple, a 30 multiple company?
I think you need to look at the best performing industrials, and that's the first step.
Are there going to be job cuts? Is that part of the way you get there?
Well, we're consistently adjusting our employee base because you have new skills and capabilities that are required, and then other skills that are no longer required. So you're going to see that on a regular basis from us as we transform the company.
Okay, I'm going to go back to sitting in my grandparents' garage with their cool Mustang that was just unbelievably cool. And then as a Ford family, we were the coolest people on the block with the Bronco with the white top. And my father folks would take the screws to the Bronco and actually take the top off in the summer as well. Tell me about the romance and the sales you've had with this new Bronco off of that memory from 1969.
We can't make enough of them. Demand is very high. And I think the design team did an incredible job taking the attributes of that historic Bronco and bringing it to the new Bronco. And
you can provide a profit model of 34,000 base?
We can.
What's the average sale price of a Bronco?
Oh, the average sale price of a Bronco, it's 50 plus.
I mean, my father would be in the auto room. I don't know. I don't need the rust stuff, and I just think we got to bring this down $100. I mean, that's the way it used to be. You can't make enough of them.
We can't make enough of them.
It's still, at the end of the day, it's about the romance of selling autos during a football game. That's still what this is about.
It is, and that's what's great about Ford Motor Company, Bronco, F-Series, Mustang, the iconic brands. There's incredible demand for them and incredible power in there.
John Lawler, thank you so much. Bring Farley with. I'd like the two of you, at the same time would be great. We could go back. Farley never talks about finance stuff. Well, he doesn't want to talk about.
Are they the same person?
They could be. Well, to see John Lawler with the Ford Motor Company, Dearborn, Michigan. Stay with us. Futures negative 18. The Standard & Poor's down 0.4%.
If you're just joining the program, we've been talking all day about what's going on with respect to the Fed, with respect to the ECB coming up in about, to have an hour. Basically, we're going to hear from Christine Lagarde, and in a half an hour, we're going to get the rate decision. And we get this note from Torsten Slok, which kind of builds on what we were hearing from Winnie Caesar, basically saying credit is more attractive than equities, and it's the most attractive to equities in 15 years. And this is sort of the divergence right now. There's a secular story of growth in AI, and then there's everything else. And then in credit, there's yield, and people like the income for the first time in a long time.
And Winnie Caesar went to this quickly, but nevertheless there it was, folks, the idea that out a certain duration, if you get a disinflation, if you get an Ed Hyman move, a Rosenberg move, and others where we literally get the rate down, all of a sudden, you're not just clipping coupons, making the carry, you got a total return opportunity.
Yeah, but I keep thinking about whether actually companies and individuals are actually paying these rates that we keep talking about, right? The sort of less credit sensitive, less interest rate sensitive aspect of credit based on what we were just hearing, based on this idea that John Lawler was talking about that people are finding ways to finance in new manners.
I think this is huge, and it's in retail sales.
Lower.
This is a huge deal, what Lisa just brought up, this new financing that we're seeing from a firm and other people like that as well. Futures negative 17. The VIX, it's elevated a little bit, 14.14. The pre-market and the Ford Motor Company, I can bring that up on the Bloomberg Professional Service. Ford rocketing. Well, actually not, 14.05. This is Bloomberg.
The tricky part of this pause or skip, the Waller skip as we call it, was messaging it. Much of financial markets have ignored that many central banks around the world that had paused have had to reassess and go back in. Bank of Australia, the Reserve Bank of Australia, the Bank of Canada in the recent week, ECB. And I think the Fed doesn't want to look like any pause that it takes is behind the curve and not continuing that process.
Diane Swank, original and brilliant yesterday. I can't emphasize enough the original economics of the gentlelady from University of Michigan. And she was really prescient yesterday on the policy mix that's wrapped around the American economy. And frankly, Lisa, of two Americas, Swank discusses the haves and the have-nots different than most Wall Street economists.
And how difficult it is to parse through the haves and the have-nots to some sort of collective trend. You've been really good with this, that sort of the aggregate of all the individual data points really does not tell the story right now.
Alan Meltzer used to get so angry at me about this. The giant of Carnegie Mellon would just say, you got to aggregate, Tom. There's no other solution. And I get that, but it's ever so more every quarter where America's disaggregated, to say the least. On the data front, let's focus on foreign exchange now as we go to the ECB, really in half an hour and an hour, and also the economic data. DXY is deceptive. It's stasis. But I'm going to go to the Japanese yen, which is weaker and signals that also through euro yen blowing out to a 153. This may be sort of oddball here and off the radar, but nevertheless, I would say watch China. Watch Japan and the challenges of YCC.
Yeah, Japanese policymakers came out overnight and said that it was suboptimal, some of the moves in their currency. You know, the question around, again, how long they can sort of remain in this yield curve control environment with the strength that we've seen in the Japanese economy.
Suboptimal as well is to have Megan Green on right now.
Never.
She's Global Chief Economist, Kroll Institute, Senior Fellow, Brown University, and is constrained within the monetary and central bank derby of saying much because she will darken the door of the Bank of England here in a month or two and is restricted on what she can say. And we're going to respect that and get good value from Megan Green without saying what's the Bank of England going to do next. Megan Green, again, congratulations on your appointment by the Bank of England. We look forward to the coronation in London. Megan, it is an absolutely unusual time. I was thunderstruck by a grizzled veteran like Mike McKee's voice yesterday at 2 p.m. over the shock and awe. None of this is in the textbooks at Brown University. How original is our monetary economics?
Yeah, I think we're in a really weird period. Look, every major economy has had successive shocks between a pandemic, a war, a cost of living crisis. And the top-down data tells you whatever you want it to at the moment. There's something for everyone. And so I do think you were talking about aggregation before. I do think trying to overlay some of that top-down data with some bottom-up data can be a useful gauge on what's going on. You know, I wasn't surprised by this pause by the Fed, nor was I surprised that they're not done yet. I do think that there are some underlying inflation pressures and that the Fed has to kind of play towards the risks that it's seeing rather than just taking what its central forecast is.
Are we giving up on a dual mandate? Do we have a given central bank, in this case the United States, migrating towards other central banks' single mandate process?
I don't think so. I just think that one part of the mandate is of absolute primacy in the U.S. now, inflation, and that's because inflation hurts everyone, but it hurts the bottom parts of the income distribution the most. And so I do think that that's what the Fed's really looking at. It doesn't mean that it doesn't care about, you know, inclusive employment. In fact, if the labor market started to deteriorate pretty significantly, we would see a shift back, I think, towards looking at the labor market and employment more closely by the Fed.
We're about 25 minutes until the ECB reveals their hawkish pause or hawkish go. It's not going to probably be a pause. That is the expectation. And as we get closer to that, Megan, traders in the debt markets have raised the odds of a 4% ECB peak rate to 50%. That's a significant increase, and the most going back to March. Do you see that as probable?
So I think it's difficult. The Eurozone, unlike most other major developed economies, is actually in recession now. The US, the UK, Japan, they've all skirted recession so far. And so that does push the ECB in a tough position because, of course, they're stuck with this trade-off off the back of successive supply shocks between inflation and output. So I would agree. I think they'll hike today. They've effectively transmitted that. I don't think they're done after today either. But like every other central bank, I think they really are going to be data dependent, and they'll look at the evidence. So it will very much depend on the data that's coming out. If the recession, the very mild, tiny recession that you really have to squint to even see in the data, If it doesn't get worse, then yeah, we may see additional rate hikes. We might see 2 more. But if the recession deepens, and I don't think that's the case, I do think the recession will remain mild. And that's based in part off the back of, strong consumer confidence in Germany and other parts of Northern Europe. Then, I do think that they'll end up hiking more.
I love how tortured we've all become, Megan. We all talk about how you can select whatever data point you want and make the story you want to tell. And then you say, well, ultimately we are data dependent because we have to look and find the stories that tell the right ones for each institution. How much is the story for Europe really the PBOC over in China and what they do in terms of stimulus?
So I actually think it's less than what we would have seen in previous Chinese recoveries, largely because the recovery in China this time around is consumer driven. And so that comprises of Chinese consumers buying domestic services and not buying capital goods from outside. So of course, in commodities in particular, a Chinese recovery will bid up prices, and that will have knock-on effects for the rest of the world. But relative to previous recoveries we've seen in China that were investment-led, there will be much less spillover, both in terms of growth, which is a negative, but also in terms of inflation, which is actually positive given that everyone else has an inflation problem.
Megan, I want to get out front of the potential green descent that we'll see at the Bank of England. And of course, I don't want you to talk about Bank of England policy. But in your study of the academics of central bank, how did America get to where we don't dissent? Do we blame it on Alan Greenspan? I mean, America seems to be dissent-free among our central bank. Why is that?
I think it's partly to do with kind of the management style of the chair. It's not that you don't ever have a dissent at the Fed. There are dissents. They're just very rare. On the flip side, when you do have them, they really stand out. You really do get a sense of the debates happening on the board at the Fed among the voters. And so they happen. They're just less frequent. I do think it's partly baked into the culture a little bit as well. So some central banks really value dissents to show that they're having debates about, everything that is really relevant. Some central banks prefer to have those debates behind closed doors, but actually come up with a consensual approach, a consensus approach, rather. It really differs, but I think it's due to the culture, partly.
Well, we declare victory. We got through that interview with Megan Green, who will join the Bank of England here in the coming months. Megan, thank you so much. Greatly appreciate that this morning. It's difficult. Talking to people going into some form of central bank or, frankly, other institutions is clumsy. And it's even more clumsy when they come out. Like when Vice Chair Clarida left the Fed, you're like, okay, well, what's he going to say or not say? And with each individual, you have to get the lay of the land about where they're going.
I have no doubt that Megan Green will have a very clear and potentially controversial voice in her view as she plots her path forward. She is not shy, so I'm sure that's in the spirit
Catherine Mann of MIT has had a demonstrable impact.
And
there's no question about that.
There is a greater degree of dissent encouraged, perhaps, in the Monetary Policy Committee for the Bank of England. I wonder when we write the book on Chair Powell, what people will say, right, in terms of his leadership.
It's going to be fascinating.
And I'm curious about some of the internal negotiations, particularly you said yesterday was historic. I agree with you, and I wonder what that meeting was like as they came and parsed through the language of how he was going to respond to all the questions.
A good monograph is Lawrence Meyer, who was a governor of the Fed, and he wrote a beautiful short treatment pretty much on Greenspan called A Term at the Fed, and it's really worth reading. It's a bit historic now. It's not current, but Larry Meyer had a very candid book about that process. We'll have to see. What's really sick about the Bank of England is David Blanchflower of Dartmouth had the Megan Green job there at one point. He tried to get the Bank of England to buy Cardiff Football, and it didn't work out. He was pushing for that as well. Let's go to the bond market right now, and I'm sorry, 5.21% on a 3-month T-bill, and you compare that distant to a 3.82%. 10-year yield, the 2-10 spread, 93 basis points.
Two-year yields, the highest since the banking crisis really took hold in March, 4.76%. Just a huge shift up from a low as recently as March 24th, 3.76. So almost a full percentage point gain over the span of just 3 months.
Our focus on the ECB. Jordan Rochester will join from Nomura. Stay with us. This is Bloomberg Surveillance.
The full effects of our tightening have yet to be felt.
This was a very effective way to message we're going to assess what tightening is out there.
They should have hiked today, but I think they got stuck on timing.
The longer that you don't see the response in labor markets, in inflation, the more the data is telling you that you're not tight in terms of policy.
From a market perspective, they for sure are trying to tell us that core inflation is too high.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
And over to you, Christine Lagarde. This is Bloomberg Surveillance. Welcome back. Good morning. Tom Keene, Jonathan Ferro, Lisa Abramowicz. Tom will say that John's on assignment. He is not. He is on vacation, on holiday. And we are very happy that he's getting some time off. He will be returning in a couple of weeks. But we will miss him today because we are about 15 minutes from the ECB decides whether they go, how far they go, but more importantly, what they signal.
First time I ever saw Ferro. I'm sitting in New York, and there's this odd duck on the lawn of the ECB. I'm like, who is this guy with the British accent? And then he opened his mouth, and he actually knew what he was talking about. It's like Maria. It's like really great.
This is about as much of the ringing endorsement as anyone gets from Tom Keene. So there you go.
I was like, who is this guy? He's very good.
As we go toward that meeting, we are seeing the odds of potentially getting to an even higher terminal rate for the ECB creep upward. And you have brought this up, Tom. This, to me, is really key. Do they have the growth profile, especially without the tech juggernaut? Do they have the growth profile to support a 4% ECB rate?
To me, this is the heart of the matter. And, folks, I'm going to explain this quickly here because we've got so much to do, including a wonderful guest. And, Lisa, what this comes down to is that single emotional word for Europeans and Americans, Eurosclerosis. And the idea here is all of our heritage and knowledge of 20 years where Europe just can't get it done. They don't own Apple. They don't own NVIDIA. You know, name it all. The only thing that works is the trains. They're better than ours. I mean, we get that. That's a stereotype.
100% they are.
And we're at the IMF, and I asked the wonderful Prime Minister, former Prime Minister of Italy, Mr. Gentilini, I said, is Eurosclerosis dead? He didn't mince a word. He said, no, it's still there. With that cap on the economy, as you say, how do you get to 3.75 or 4%?
Especially if you don't have NVIDIA, if you don't have Apple, if you don't have Meta. And now
you're going after Google.
Exactly. And you're going after, well, the classic antitrust of Europe. Well, you can call it whatever you want to call it. There is this question around China, too. And Megan Green was brilliant on that just moments ago, where she said it doesn't matter as much as it would have 5 to 10 years ago that they might be stimulating, that they might be coming back. We did see that stimulus measure, a small one overnight, coming out. Again, do we hear Christine Lagarde talk about the People's Bank of China?
Well, we're going to see it here. We're going to the ECB coming up here at 8:15 today awaits in Frankfurt. And a good guess you're going to get to in a moment. I'm going to do a data check, truncated and different. BitDog under 25,000, 24,961 on Bitcoin. I will opine here and say if I look at climate exponential moving averages and a bunch of trend-based ideas, Bitcoin's a little shaky. It deserves Catherine Greifeld, very close analysis here, going from 26,000 down to 24,958. Ferro just fell off his beach chair on an island in Italy.
Well, can I give you some of the broader market feel? Because we are getting a bit of a softness after yesterday's rally, particularly the tech stocks. And we're looking at NVIDIA. We're looking at some of the other tech darlings, Tesla, coming off some of their incredible rallies. A bit of perhaps taking a deep breath and
come
reset.
on, one day off. Get over it.
But
the VIX is 14.11.
Yields higher. But to me, this is interesting just because of the setup, because it's a bit of a departure from what we've seen. And yields at the highest levels going back to when we were concerned about some sort of banking crisis.
Quickly, the euro somewhat elevated at 108.15.
And some people suggesting perhaps it could go even higher, significantly higher, stronger versus the dollar, including Jordan Rochester, G10 FX strategist over at Nomura. Jordan, you have these fantastic calls where you give a call and then you give your conviction level, which gives us a sense of just, what the oomph is behind it. Long euro, that's your latest call. What's the rationale?
The rationale, Lisa, good morning, Tom, as well, is that essentially what we've seen that drove euro lower in the recent sort of move was the data surprises really turned against the euro area. We had growth that really disappointed. We even had a weak CPI number, and that just took the wind out of the euro trade. So we had it on most of this year, long euro dollar. but it's been a bit of a zigzag. It's been really monotonous for everybody to trade, washing people out of what essentially is a trade where you wanted to trend higher or lower, and then you get mean reversion. And it's not a market that has been helpful to anyone in the macro space. But I think, Lisa, what's changed is those data surprises are now extremely low for the euro area. So I think economists from here probably will revise down all their estimates for growth, and the markets will be less reactive to, say, a weak manufacturing PMI. Next week, we've got the flash PMIs. Maybe services comes in weak as well. But I think the market might shrug that off because it's already in the price. And what's changing is the correlation of euro-dollar. So if I was using a rates framework, I'd be absolutely short euro-dollar right now. I thought actually that euro would get down to 106 towards 105 because rates would say we should be towards that, two big figures from where we are. But we're in a correlation regime change. What's happening is the equity market had been quite range-bound for quite some time, and then this AI boom has just changed everything. And also, as we're getting closer to the end of the Fed hiking cycle, so equities are higher. It actually suggests DXY should be towards 97.50. So I have this tug-of-war between equities say euro higher towards 112, but rates say towards 106. And I'm putting the weight on the equity momentum. I think that's going to help the euro and other assets as well against the dollar.
Well, the two ambiguities are nicely explained. Jordan Rochester, you say washed out, which maybe describes a season for Tottenham. But I look, Jordan Rochester, at what that really means in FX trading, which is stop losses. With all this ambiguity back and forth and difficulty in trading, how do you establish stop losses if you've got such a narrow idea of where you're going? How do you set up a stop loss if you're only looking for two big figures?
You've got to be careful with how much of your take profit versus stop loss ratio. So ideally, you want at least a 2-to-1 ratio if you're doing a cash spot trade, which we tend to do. So you're looking for 4% upside, you have a 2% stop. And over the long term, you just hope that on average, you're at least 50% or more higher hit ratio. So you'll always, in the end, make money. The other side as well is you take leverage, Tom. So you can do this in leverage plays. Vols are selling off right now, making those leverage plays quite cheap, but realized is also quite low. What we're talking about is a story, Tom, in the second half of this year of a breakout in euro. So maybe vols head higher this year when we break through, let's say 108 towards 110. When we get to that 110 level, that's when momentum will come in. That's when the CTAs will start buying euro as well in decent clip. And I think that's when you get that sort of breakout that makes those take profits get hit.
ECB here in 8 minutes, folks, and then the Lagarde press conference. We're supposed to continue with Eurobabble with Jordan Rochester, but we can't. He's with Nomura, and he's very good on yen. I am fascinated, Jordan Rochester, with the signals of Japanese yen, euro yen well out over 150. The 141, I looked very carefully at log dollar yen today. Where's the weak yen point where the sweat clicks in Tokyo? Is it 141, is it 143, or is it demonstrably back to that $150 yen level?
What a description. Well, when the sweat kicks in, Tom, when we get towards those levels of 145 to 150, those are the FX intervention levels we saw last year towards Q3, Q4 time from the Bank of Japan and the MOF when they wanted to intervene to strengthen the yen. And that was in a period where the Fed was getting very hawkish. Global inflation was going up. Energy prices were going up. It's actually a little bit of a different setup this time around. What's happening is we're having this sort of grind higher in US yields. The market has been kind of fighting the Fed the whole way. And we were in Singapore and Korea last week, Tom, and one of the favored trades for the second half of this year from clients was to be short dollar yen. And it's been an absolute pain trade so far this year, with the Bank of Japan disappointing hawkish expectations of perhaps a change in yield curve control. It's either June or July, we think. But that's not enough because the Fed's doing much more than BOJ to tighten. So in the short term, Tom, there's not really much stopping dollar yen from heading higher. US yields and risk on in equities are making it a trade that goes up.
And Lisa, this is critical how Mr. Rochester folds yen dynamics into the United States two-year yield, which you just mentioned 10 minutes ago, out to a 4.77. I mean, the linkages here are tangible.
Especially because a lot of international buyers really have funded a lot of the U.S. market. Jordan, you're talking about interest rate differentials. Have we shifted back to an interest rate differential story driving FX volume versus growth differentials, which still remain in question?
It's been actually the two working against each other to make life really tough for everybody. So The yield story in the last few weeks would say dollar strength, absolutely. And you're seeing that in dollar CNH and a few others. But if you applied that dollar CNH framework to the rest of the G10 and Asia, you got absolutely smoked, because the equity rally that's happened has seen the likes of dollar Korea lower. All this AI semiconductor sort of sentiment has helped the likes of Aussie dollar higher. Then you've got what's happening in the UK with the Bank of England, with the real rates moving as high as they are. So in the UK, it seems real rates are correlating. So that's why shorts euro sterling has worked for folks who had that on. But I do think that it's looking a bit frothy in the UK rate space, 130 basis points. So Lisa, yes, the answer is yes, rates do apply. But broadly speaking, the equity component is making things tough for everybody.
We're speaking with Jordan Rochester of Nomura. We're about 4.5, a little bit less minutes away from the ECB rate decision, euro strength, as we do expect some move and a signal toward additional rate hikes, although actually it has turned around as we have been speaking. Jordan, I don't know what you've done, but we now see the euro lower versus the dollar. It's been fluctuating. At what point does the GDP story for Europe become a problem, even in face of potentially more hawkish policy, at least based on the cycle of where they're at versus the Fed?
It really will be a problem if growth remains in the doldrums like this for, let's say, the rest of the year. You can't ignore growth. Growth drives inflation. Inflation drives central banks. But what we're experiencing right now is the lagged effects of the inflation of last year and feeding through to core inflation, all of that services CPI creeping through. For the ECB today, Lisa, just got to watch out. They're going to raise up their core inflation forecast, in our view. They had around 4.6 for the average of this year. Inflation of core in the euro area has been on a 5 handle for most of this year. The ECB needs to be hawkish. You've got credit spreads tightening, equities at the high, and now, unfortunately, you've got natural gas prices shooting back up. So inflation hasn't gone away. If that carries on, Lisa, I'd be surprised today if we get a dovish meeting.
Needs to be hawkish. As we go to this meeting 2 minutes away, 2.5 minutes away, the announcement rather, before the press conference. Jordan Rochester, what is the power, the influence of the Bundesbank at this 8:15 New York time?
Well, every country has a vote, has a say. There's a rotation, of course, of those countries.
Listen, he's running for office.
Some do and some don't get to vote at this meeting. But there is one aspect of everything that is a dampener on the mood, which is manufacturing and housing. So if you look at those components of growth, it's not looking great. Germany has some indicators saying house prices are down 10%. However, the average household in Germany and France has barely felt the impact of the ECB raising rates because they've got 10-year, 30-year mortgage rates that are fixed, just like in the US. So yes, there are clear signs that there are problems creeping up, and that's going to lead to regional differences. But for France and Germany, the average consumer hasn't felt the impact of an ECB rate hiking cycle. So for the time being, I think they'll still have to lean hawkishly.
Jordan Rochester, stay with us. We're going to have your comments here as we see the headlines come out. Jana Randall, writing for Bloomberg, and she reports this morning it is a home stretch of historic hiking cycle. Lisa, you alluded to that earlier.
It seems like we're getting to the end. This might not be the end for the Fed. It might be, depending on who you are. Ellen Zentner might argue that it is the end of the hiking cycle. Over at the ECB, maybe there's one, maybe there's 2 more hikes left, maybe there are even 3. But you're getting to this feeling that they now have to decide when to pause, when to skip, what the damage is to the economy versus signaling and trying to job on the market and doing the work for them.
And what's interesting about this, we have to go back to first principles here coming out of Duesenberg decades ago. They don't have a fiscal policy. They don't have a unified fiscal policy versus the advantage that Jerome Powell has. He may not comment on it, but at least Powell has one Congress spending oodles of money. It'll be interesting to see how Lagarde addresses that today, given Maria Tadeo emailed me moments ago saying the GDP focus is front and center.
Christine Lagarde has done, I have to say, at the previous press conference, she did a good job. And she's been very clear in her message. She has the luxury of clarity at a time when inflation is still very high and they're further behind the Fed in terms of the rate hiking cycle. Will this be short? Will this be clear, declarative? We've got more work to do, period, full stop. Not necessarily even basically humoring people saying that anything should slow down. It's almost an easier job for her than it was for Fed Chair Jay Powell.
On radio and television internationally, and of course across America, we welcome all of you here after the Fed festivities yesterday. The European Central Bank in Frankfurt will have headlines out here. We'll do that in about 30 seconds. And then, of course, the press conference with Christine Lagarde coming up. The benchmark, always a euro, a 108.29 on euro. That was 105, 106 recently. I thought Jordan Rochester set up beautifully the ambiguities there of what euro will do, not only in the coming minutes, but also in the coming months as well. U.S. two-year yield is of note, up 6 basis points, 4.75%. I'm still trying to figure out the reach to a 5% U.S. two-year yield. We're waiting now on those headlines. They're slipping out right now. I'm going to do my imitation of John Ferro. They raised the marginal lending facility to 4.25%, which is the key headline, but raising the deposit facility as well by 25 basis points, the main refinancing rate by 25 basis points. John just fell off his beach chair in Italy. Save me, Lisa.
Basically, this is in line with expectations, raising the main rate 25 basis points to 3.5%. That was the expectation, saying that they are going to continue to apply flexibility on some of the reinvestments of the assets under investment, talking about price pressures remaining strong. Basically, inflation still the preeminent concern. This, to me, is quite interesting. The ECB sees the 2025 inflation rate at 2.2% versus the prior forecast of 2.1%, increasing their inflation expectations at a time when people more broadly have been hoping for perhaps energy prices to decline and fuel some sort of disinflation.
They go out in time differently than we do, but to 2024, the prior forecast of inflation was 2.9%. And with all the challenges out there, this is my first question to Madame Lagarde this morning. You come up from 2.9% to 3.0%. What is a tenth of a percentage point adjustment 1 year out signal? I have no idea.
This perhaps signals a bit more. When you take a look at core, we talk about core inflation in the U.S. all the time. When you strip out energy, when you strip out food in Europe, they see that rate now in 2024 of being 3% versus the prior estimate of 2.5%. So a significant stickiness to inflation over the longer term at a time when wages are going up at a pretty healthy clip. And this has been the distinction. And across the world, the labor dynamic has really been one of the biggest surprises.
And the huge distinction here is the GDP differential in Europe versus across the Atlantic to the United States. I know Maria Tadeo says this is key. The view out 18 months to 2025 is a European GDP of 1.6%, which speaks volumes. We're getting some of the more nuanced headlines now. Growth in loans is slowing, tilting to banking, tighter financing conditions to increase. Some of the themes here. Look at this coming out. This is a red sticky in Bloomberg reports. ECB will ensure rates reach sufficiently restrictive level. Lisa?
And downgrading potentially some of their growth expectations. So again, how much is this going to be a messaging device to say we are committed to bring down inflation, the inflation threat is real, and yes, we may have to sacrifice growth?
The litmus paper for the European system, the German two-year yields moves a solid 14 basis points. That's a ginormous move, 3.15%. And you see a lift in the U.S. two-year as well, 4.75, fractionally out to 4.76. And again, the euro as a litmus paper of the system has a modest bid, 108.39. Shaking her head on the lawn at the in Frankfurt is Maria Tadeo, realizing that was the worst release of the press release by Bloomberg Surveillance in history. She's saying, where is John Ferro? Maria Tadeo joins us now with perspective from Frankfurt. Maria, your thoughts as markets move?
Well, Tom, it's a 25 basis points hike. We were expecting that. But when you look at the numbers and these projections that we got today, you see that inflation ticks up and GDP goes down. So in other words, they are hiking into a recession. And that was the scenario that they wanted to avoid. What it does tell you is that in many ways, the downside risks continue. The story over the energy, we thought the panic was over. And I remember the panic a year ago. That panic may be gone, but the fears, the scars, the fallout, it is still there. When it comes to inflation, they also say it. They are going to have to continue to probably increase rates and continue to hike. But on that note, what is clear now is that this is almost the end game. It's a hike today, potentially another one in July. But at that point, when you get to that point, that's when you see the real tensions kick in the governing council. Everyone needs to make sure that they feel comfortable with the policy. They need to feel sure that they have done enough to tame inflation. This is a single mandate central bank. And I always say this, and people tell me you're too European, you're too nice. this to the European Central Bank. But the reality is this is a constant balancing act, and these are 20 different economies, Tom. You cannot forget that.
We're looking right now at yields markedly higher. German yields at 3.12%, climbing significantly on the day. With a 13 basis point change, we're seeing the euro marginally higher. And this coming out that the ECB is planning to discontinue APP asset reinvestments in July. So not only raising rates by 25 basis points, but also perhaps tightening the screws on the liquidity side of things. Maria, do you think that this indicates that we're going to hear from Christine Lagarde in about 25 minutes here that they are planning to hike more and that they plan to withdraw stimulus through their balance sheet?
Look, we know that some members of the Governing Council had already asked for this for a long time, and they had said, not just this, but remember the TLTROs too, they had said we need to drain some of the excess liquidity already because inflation is unacceptably high. It continues to be unacceptably high in the euro area. Also, not just headline, but when you look at core, and this is a number they really look at, that continues to be a problem. I think one of the key questions, and you alluded to this, it's what happens in July, and that's the question. Is that one final one and you're done? You feel the monetary policy has done the job and it will really apply, or is it more July, let's take a break, it's also very European, clock out and reassess in September? To me, that's a key question now.
Within these headlines, Maria, today, quickly, do you see the hands of the Bundesbank and the hawks that say we've got to be more restrictive?
Look, I think they have obviously pushed that line, and they have been winning that argument. How can they not when you see the inflation numbers the way that they are? But I would also say one thing. When you look at the Bundesbank, it is an inflation situation, but they also look at an economy that has taken a huge hit because of the energy situation. You've seen gas prices today. And Tom, when you come to Germany, you talk to CEOs, you talk to the German government, that anxiety about what's the future of the German industry, that continues to play in. So this time around for the German Central Bank is not just about inflation. It really is about growth.
Maria Tadeo, thank you so much, reporting there and out front on the analysis of GDP, original GDP, I should say, within some nations of Europe. We continue with Jordan Rochester, G10 FX strategist at Nomura. Jordan, let me go and overlay the GDP question on your Euro call. Germany's not getting it done right now. How does that change a Euro call from Nomura?
Well, right now, Tom, we already knew growth would be weak. We've got that from the PMIs, the surveys. So I'm not really convinced that the GDP is the way to look at Euro right here, right now. In the short term, what's more important is what they did to those inflation forecasts, Tom. So there's been a bit of a revision down in the front end for headline. But for core inflation, what's been surprising from this release is that we've got, on average now, 5.1 from the ECB for core inflation this year, up from 4.6 in their forecast previously. I said earlier that it was too low. It was going to be revised up, but I was discussing it with Andre and our economics team. We thought the ECB might not pencil in a 5 handle for their core inflation, just because that's a number that will make them very uncomfortable for the average of this year, 5%. This is none of these forecasts for inflation have it going back towards 2% and actually going below 2% in the horizon. The 2025 inflation forecast revised up just very slightly, but all of this says the ECB is being hawkish. We'll find out in the presser how Madame Lagarde will express it, but we've seen the pricing, Tom, for the ECB for the next meeting jump already to 25 basis points. Ooh. The market was actually doubting a little bit if that would happen, and now we're actually now toying with the market thinking maybe this carries on. Maybe this goes to September. And Tom, the market is very happy pricing many 25 basis point rate hikes for the Bank of England. And I suggest that maybe if that's the case, we need to consider it for the ECB.
Just quickly, does this make a 4% ECB rate much more likely and actually the base case in your view?
It's not the base case, but look, it makes it possible. And the reason why is because we're seeing all this animal spirits in equities pick back up, boosting risk sentiment, boosting the sort of inflationary pressures that we could see this summer. And as I mentioned earlier, natural gas going up, that should really worry the ECB if it's like last year. August last year, we had energy prices at the highs. It's just June now. If we get 2 more months of gas storage demand pushing up inflation again of natural gas, it upsets the apple cart of the big disinflation. All my charts say the euro area inflation is going to really slow down. But that will change if natural gas keeps moving the way it is. So If it carries on, Lisa, it's potentially possible.
Jordan Rochester, thank you for the effort today with Nomura there, and really interesting nuanced call on euro weaker or euro higher. Certainly euro higher is the call out. I've never done this. I'm going to do it right now, Lisa. We do this on the Bloomberg, and we do it in real time, folks, which is sort of cool. And I can go to the Euro Stoxx 50, which is somewhat like the, John wanted me to quote this, it's somewhat like the Dow Jones Industrial Average. John would say it's superior, up 32% off the October low, you know, sort of an equivalent to the U.S. debatable bull market. You've got Euro stocks up 32% set in euros here as well. So that's not a small item, the stock enthusiasm that you see.
And how much does that run into a massive headwind with that German two-year yield now 3.15%, surging on the heels of an incredible hawkish ECB. Yeah, you can really see it materially higher, a significant 15 basis point increase, because right now we're looking at the potential for the Fed and the ECB to move more than many people thought was possible.
You're not going to get an ECB coverage like that anywhere in the world except from our economics team in Frankfurt, in Washington as well, on the Fed and on the ECB. Maria Tadeo will give us further nuance through this morning. Lagarde, in a bit. Please stay with us. Economic data next, retail sales and claims. Good morning. To American economic data. We'll do that in 30 seconds with Michael McKee. But right now we see continued debris from the ECB announcement. And Lisa, as you mentioned, the two-year yield, 3.15% in Germany. That's a substantial higher yield.
It is the highest going back to early March. And we can see that 14 basis point climb as people reassess just how far the ECB is willing to go, moving up their projection for core inflation in the euro region to 5.1% for this year from 4.6% previously, and increasing their expectation in 2024 to a 3% ex-food and energy inflation read from 2.5% earlier, Tom.
John Lawler, Ford, saying it's a buoyant consumer out there buying Ford automobiles. Michael McKee sees that in the retail sales data. Michael McKee, what do you have?
Well, we've got a cornucopia of news, or a tsunami of data, whatever you want to call it. We'll start with retail sales coming in on the month up by 0.3. The forecast was for a 0.2 decline, so stronger there. And ex-autos up 0.1. So autos contributing this time, even though people thought they would not. Of course, it's different from the unit sales, the measure. The control group, still waiting for that number to drop. That's the one that economists tend to look at, leaves out stuff that's double counted. Import prices out. They are down 0.6%. Ex-petroleum down 0.2%. So a lot of that is energy. Okay, retail sales control up 0.2 after a revised 0.6 the month before. That matches expectations. And so we are still seeing Americans spend, but at a lower rate than they did in April. The other number that we care about, initial jobless claims, is unchanged at 262,000. So if you want to make it hard for the Fed to read the labor market, there's a good number for you. You don't know what's going on, whether last week was a freak number or whether it is now a new level. Empire Manufacturing, big jump there from negative 31.8 to 6.6. And Empire Manufacturing, the Philadelphia Fed, comes in at negative 13.7 after negative 10.4. So I'm not sure what you can make out of the regional indexes, since they are sort of the opposite of each other. I'll let you do the data check, and I'll see if I can find out what's going on with the retail sales and where the strength was.
8 ways to go here, and on retail sales, and particularly on the manufacturing data from Philly and Empire. I'm going to call it a churn to the market. We saw lower yields off the shock, and then we've come back with a reaffirmation of two-year yield up 5 basis points, 4.74% to 10-year yield, 3.81%, 30-year bond, 3.89%. I guess it's not a big deal, but am I on the 4% watch on a 30-year bond and all of its emotion into American housing as well? Equities give me no love, negative 17 on SPX futures. I'm looking at the euro with some Jordan Rochester strength here in the recent seconds off the ECB data. And Lisa, before we go back to Mike, we got to look at claims. back-to-back 262, which gives you a 4-week moving average, which is literally a jump condition off of the glide path of higher claims that we've seen.
I'm so glad you said that, because this is really a confusing data dump, because you're seeing on one side the strength of the consumer continuing to spend, and you see the empire manufacturing, things coming back in the good sectors perhaps, but jobless claims, the labor market seeming to lose some steam. I do wonder how you put those together. Is one lagging and one leading, and which is the leading one that we can really focus on?
Michael McKee, a quick second look at retail, which you'll do much better on in 45 minutes, but what is the nuance of retail sales? What do we spend money on?
Well, basically, Tom, it looks like we spent money on everything. Very few categories of weakness, only really gasoline, which is not going to surprise anybody because retail sales are calculated in dollars. So as gas prices fall, so does the percentage of sales. And gasoline stations were down 2.6%. They were down 20% the prior month. But everything else shows mild gains from the last month's building materials numbers were down. And then in May, they rose 2.2%. I guess might have been a rainy April. And cars surprising analysts because they thought, based on unit sales, that might be lower, but they come in up 1.4%. Again, that's dollar volume as opposed to unit sales. And if we look at the department stores, up 0.4% for general merchandise, 0.3 for department stores. So people were out spending money, 0.4 gain for eating and drinking places. Tom continues to do his part for the economy.
I'm working on it.
And overall, it just kind of looks like people were still spending money, a little bit less than last time, but still out there spending.
Does this data dump really signal to you resilience or a labor market that is starting to get chipped away, that is starting to lose steam?
Well, it may be losing a little steam, but it's hard to see that it is rapidly changing, Lisa, because we still had that big JOLTS number. It is a 2-month delay, but it does show a lot of job openings still out there. And the fact that we didn't see a rise in jobless claims is telling you that there's something status quo about the economy now. It does seem to be status quo at a little bit higher level. But you can't really look at it and say we're going to see a big jump in unemployment coming because right now the numbers don't support that.
Michael McKee, thank you so much. Greatly appreciate it this morning here on, as he said, a substantial set of economic data. Futures deteriorate a little, -16, -18, down just a fractional amount. The VIX 14.14. Jay Bryson writes, heard over terrific economic team at Wells Fargo. They have a fabulous heritage of measuring this nation from sea to shining sea. And right now I'd like you to go over the other C, Jay Bryson, to maybe summarize here what Wells Fargo sees in manufacturing in America versus the clear slowdown in manufacturing in Germany. What is the state of the economy of manufacturing in America as we look at this data this morning?
So, Tom, I guess I'd roughly say that when I think about the manufacturing sector here in the States right now, I would say it's flat-ish. It's if you look at the hard data of manufacturing production over the last year or so, it's been kind of flat. And I think what's going on there is two things. There's a slowdown in the rest of the world, so we're not exporting as much. And then secondly, is there has been, as you well know, there's been this rotation over the last year away from spending on goods towards services. Goods obviously are manufactured, and so manufacturing is, again, it's not really contracting, but it's not growing. It's, as I said earlier, I think it's kind of flattish right now.
Which is the best leading indicator of all of the data that we just got? Is it the retail sales coming in hotter than expected, or is it unemployment rising, perhaps at a faster pace, at least jobless claims, than many people expected?
Well, at least I guess I would say they're both kind of coincident sort of indicators. Certainly that's what we think about the labor market as being very, very coincident. It gives us an idea where we are right now. In terms of the retail sales sorts of numbers, it's a little choppy in there right now. But what I would say is what it's showing us is that the consumer continues to spend at a modest pace. As long as that continues to happen, then the consumer sector isn't going to completely fall apart either. And so I think where we are right now in terms of the economy is, if you look at the first quarter, we grew roughly 1% at an annualized rate. I think that's kind of where we are right now in the second quarter as well, somewhere, plus or minus 0.5 of a percentage point off of 1% right now.
If nothing really changes, no sort of big shocks to the system, and we get data like this for the next, 4 weeks, do you expect the Fed will have to raise by another 25 basis points, that yesterday's meeting was not the end of the rate hiking cycle?
I think that's right, Lisa. And I kind of think of it as yesterday was a little bit of a compromise between the doves on the committee who kind of want to pause right here and the hawks who kind of want to keep on pressing ahead. And I think it was easy for them to, the consensus, I think it was easy for yesterday to coalesce around, okay, we'll keep rates on hold, but we'll send a signal of a hawkish pause, if you will. A month from now, if we don't see any major changes to the economy, then I think it's easier to coalesce around, okay, let's bump them up another 25 basis points. But obviously, we've got a lot of data between now and then, particularly the labor market report. We get another CPI, sort of report. So, if we come in status quo, where we are right now, then I think they go 25.
I'm going to suggest, Dr. Bryson, that none of this is in Chapel Hill economic textbooks. I mean, it's absolutely original. Where we are. How much are we beholden to American exceptionalism right now? Europe has so many struggles, is seen with a subpar 1% GDP view forward, and we're different. We're doing better. Does Wells Fargo suggest there is an American difference, an American exceptionalism?
Well, Tom, I don't know if I would. So if you step back and you look at the broad sort of stuff, I mean, the United States continues to be the technological leader in the world, right? This is where AI is being developed, et cetera, et cetera. I think that will probably continue. But I also think that, right now where we are in terms of the cycle, Europe has been hit with a number of shocks that the United States hasn't. Particularly the war in Ukraine and the spike in natural gas prices that everybody was talking about just before we came on air here. And so there's been a lot more shocks hitting Europe than there has been the United States. So is the United States exceptional from a very, very long run standpoint? Yes, but from a cyclical standpoint, I can come up with reasons why Europe is different right now.
What did you think yesterday when we had esteemed people like you on who said they just should have raised rates and stopped with all this mumbo jumbo, skip, pause, all this other stuff? Jay Bryson, would Greenspan or Burns have raised rates?
I don't think so. I mean, Greenspan was, at the end of the day, he was very, very cautious as well. You look at his last tightening cycle starting in 2004, it's 25 basis points, constant sort of thing. So did they do the right thing yesterday? Obviously, people can disagree on that, but we all know that monetary policy works with long lags. You are seeing signs that the economy is growing at a sub-trend pace right now. I mentioned 1% before. Most people believe that's going to be sub-trend. And if it continues to grow at sub-trend, that will bring the inflation rate down over time. You really don't want to put the economy into recession right now if you don't. So it's a little bit of hard communication strategy right now on their part. They're walking a very, very fine line. But, I think at the end of the day, a pause was probably the right thing to do.
We're about 3.5 minutes away from Christine Lagarde taking the helm and explaining a pretty hawkish proclamation and rate hike that we just got from the ECB. Right now, the euro versus the Japanese yen was extending the gains up 1.1% to the highest level, the strongest going back to 2008. As you see that differential in rate policies really start to bleed into the currency.
The agony back a zillion years and really not comparable. And I defer to Jordan Rochester, Steve Englander, and others, but it's a 160, maybe a 163. We're distant from OMG, the worst ever, but I think scope and scale back to 2008 really signals how removed Japan is from the other three banks.
Jay, as we set up for Christine Lagarde to give some explanation, some meat behind the statement, what are you expecting to hear? What was the biggest shocker to you at a time when this ECB is forecasting out a 3% core inflation figure next year and a 5.1% inflation this year?
I think she's going to be very, very hawkish as well. I think, she's speaking for the entire governing council. We all know that there's a lot of hawks on the governing council, and I think, what they want to send is a signal of we need to be hawkish here. Their mandate is 2%. We're far away from 2% inflation right now. So I would think she's going to reinforce a very, very hawkish sort of view. And if
Right.
bond yields back up even more on that, I don't think that's not a bad thing for them.
Is your press conference operating, Dr. Bryson, within Eurosclerosis?
Define that term, Tom. I'm not sure I get the
Just the sluggishness. You mentioned the technological superiority of America. They're going after Google again, was in the news today. Is there just that weight to the European model that was definitive 20 years ago?
They always lag us somewhat in terms of productivity growth and vibrancy of the economy, and I don't think that's going to change anytime soon. Again, when you look at all the AI breakthroughs that are happening here in the United States, and they're not happening in Europe.
Jay Bryson, thank you so much for the brief. He is with Wells Fargo. They've been hugely helpful to us here on the economic backs and forth. Sometimes there are signals of post-pandemic. This is the well-run machine, Delta Airlines, and they resume an ever so slight but nevertheless quarterly dividend after a 3-year agony.
They're having their annual general meeting, and we are hearing more and more about normalcy returning, but really interesting at a time when travel has really fueled a lot of the expenditures and the, frankly, inflation that we've seen everywhere. I guess that the idea is to potentially inflate some of their valuation. We are waiting for Christine Lagarde. How much is travel a big part of the European story, especially with the euro losing
salvation.
value?
The tourism
Yes,
is GDP salvation. Let's not mince words.
Which is perhaps the reason why you're seeing a different picture in Southern Europe than in Northern Europe. Southern Europe perhaps getting more of the dollars and other currencies.
I happened to talk to a guy. He runs he's got a greenhouse up the Hudson River. I think it's like a quarter of an acre. It's this huge, ginormous thing. And he's going over on just some quick once over to see the Queen to London, and the plane ticket's like $10,000 business class. I mean, the guy only flies. His name's Marty. He only flies large, and he's going over 10,000 large to Heathrow.
Well, and you've talked about trying to get a hotel room in Paris, but all of these questions around the costs that are really feeding some of the inflation, the ability for wage negotiations.
It's not fair because, someone like me, I'm going to Motel 6 in Paris, and, Marty's going very large. We're going to start to the ECB right now in Frankfurt, Germany. Photo opportunities taken. Everybody does this differently. The chairman had lots of flags and bunting behind him yesterday. It's a stark, for those of you on radio, it is a stark light blue, clearly associated with the ECB. And Christine Lagarde surrounded by good people that will comment as well as is appropriate. But mostly it'll be this opening statement of Christine Lagarde and on to questions. I'll be listening most closely to the tensions of the Bundesbank and the rest as well.
Do you think that this is going to be more interesting than the Fed press conference?
Oh, that was awfully interesting yesterday. I mean, that's a really good question. And no, I think she will hedge it in her political way, where yesterday was more of a free-for-all. I think we're going to go there right now. This is the president of the ECB. They've got a whole process over here. Supposed to had radio, they got to move the cables away and all that. It's so much easier with Powell. He just comes out and says, "Good morning, everyone."
Well, have you noticed he is on time? That door just opens, just within 30 seconds of that 2:30 p.m. Eastern mark, which is notable. She's being introduced right now as she gears up to deliver what she's going to deliver.
Here is Christine Lagarde.
My name is Wolfgang Preußel. We are, as always, in a hybrid format, so I also welcome those who are following via video. When you have a question, please turn on your camera and the microphone so we can hear and see you. And with that, I hand over the floor to President Lagarde. Please.
Thank you very much, and good afternoon to all of you. The President and I welcome you to our press conference. Inflation has been coming down, but is projected to remain too high for too long. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. The Governing Council, therefore, today decided to raise the 3 key ECB interest rates by 25 basis points. The rate increase today reflects our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. According to the June macroeconomic projections, Eurosystem staff expect headline inflation to average 5.4% in 2023, 3% in 2024, and 2.2% in 2025. Indicators of underlying price pressures remain strong, although some show tentative signs of softening. Staff have revised up their projections for inflation, excluding energy and food, especially for this year and next, owing to past upward surprises and the implications of the robust labour market for the speed of disinflation. They now see it reaching 5.1% in 2023, before it declines to 3% in 2024 and 2.3% in 2025. Staff have slightly lowered their economic growth projections for this year and next. They now expect the economy to grow by 0.9% in 2023, 1.5% in 2024, and 1.6% in 2025. At the same time, our past rate increases are being transmitted forcefully to financing conditions and are gradually having an impact across the economy. Borrowing costs have increased steeply, and growth in loans is slowing. Tighter financing conditions are a key reason why inflation is projected to decline further towards our target, as they are expected to increasingly dampen demand. Our future decisions will ensure that the key ECB interest rates will be brought to levels sufficiently restrictive to achieve a timely return of inflation to our 2% medium-term target, and will be kept at those levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In particular, our interest rate decisions will continue to be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. The Governing Council confirms that it will discontinue the reinvestment under the Asset Purchase Programme as of July 2023. The decisions taken today are set out in a press release that is available on our website. And I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Looking at the economic activity, the euro area economy has stagnated in recent months. As in the fourth quarter of last year, it shrunk by 0.1% in the first quarter of 2023, amid a drop in private and public consumption. Economic growth is likely to remain weak in the short run, but strengthen in the course of the year as inflation comes down and supply disruptions continue to ease. Conditions in different sectors of the economy are uneven. Manufacturing continues to weaken, partly owing to lower global demand and tighter euro area financing conditions, while services remain resilient. The labour market remains a source of strength. Almost 1 million new jobs were added in the first quarter of the year, and the unemployment rate stood at its historical low of 6.5% in April. The average number of hours worked has also increased, although it is still somewhat below its pre-pandemic level. As the energy crisis fades, governments should roll back the related support measures promptly and in a concerted manner to avoid driving up medium-term inflationary pressures, which would call for a stronger monetary policy response. Fiscal policies should be designed to make our economy more productive and gradually bring down high public debt. Policies to enhance the euro area's supply capacity, especially in the energy sector, can also help reduce price pressures in the medium term. The reform of the EU's economic governance framework should be concluded soon. So looking at inflation now. Inflation fell further to 6.1% in May, according to Eurostat's flash estimate, from 7% in April. The decline was broad-based. Energy price inflation, which had risen in April, resumed its downward trend and was negative in May. Food price inflation fell again, but remained high at 12.5%. Inflation, excluding energy and food, declined in May for the second month in a row to 5.3% from 5.6% in April. Goods inflation decreased further to 5.8% from 6.2% in April. Services inflation fell for the first time in several months from 5.2% to 5%. Indicators of underlying price pressures remain strong, although some show tentative signs of softening. Past increases in energy costs are still pushing up prices across the economy. Pent-up demand from the reopening of the economy also continues to drive up inflation, especially in services. Wage pressures, while partly reflecting one-off payments, are becoming an increasingly important source of inflation. Compensation per employee rose by 5.2% in the first quarter of the year, and negotiated wages by 4.3%. Moreover, firms in some sectors have been able to keep profits relatively high, especially where demand has outstripped supply. Although most measures of longer-term inflation expectations currently stand at around 2%, some indicators remain elevated and need to be monitored closely. Turning to our risk assessment now. The outlook for economic growth and inflation remains highly uncertain. Downside risks to growth include Russia's unjustified war against Ukraine and an increase in broader geopolitical tensions, which could fragment global trade and thus weigh on the euro area economy. Growth could also be slower if the effects of monetary policy are more forceful than projected. Renewed financial market tensions could lead to even tighter financing conditions than anticipated and weaken confidence. Also, weaker growth in the world economy could further dampen economic activity in the euro area. However, growth could be higher than projected if the strong labor market and receding uncertainty mean that people and businesses become more confident and spend more. Upside risks to inflation include potential renewed upward pressures on the cost of energy and food, also related to Russia's war against Ukraine. A lasting rise in inflation expectations above our target or higher than anticipated increases in wages or profit margins could also drive inflation higher, including over the medium term.